Tell me in tell me in the chat, what is a borrower's debt service? It's two pieces. I'm looking for two words, and you can abbreviate. I know what you speak of. When we say debt service, what are we referring to? Debt service. We're looking for two words, and you can certainly abbreviate. Debt service. And if you're just joining us, good morning. We're getting set up, getting ready to get started. We're warming up, refreshing what we learned last week. And in the chat, you guys are telling me what is a borrower's debt service. It consists of two pieces. So I'm looking for two-word answer. What are the two pieces of the borrower's debt service? So a borrower's debt service. Everybody ready? The two pieces of a borrower's debt service are principal and interest. Your debt service is what you owe the bank. It's your debt. So the principal is the money that you borrowed. You marched into a bank and said, I want to buy a house. Give me some money. What they're giving you is the principal. And interest is what the lender charges you to borrow the principal. So debt service, two pieces. Guys, it's so easy to say debt service on your exam. And if you don't know that's principal and interest, and you don't know how to address that question. Any questions on that? Not taxes and insurance. It's what you owe the bank, your principal and your interest. Yep, you're in. I got you. Thank you. So we got just one more piece of math to cover in unit 6, and then we got some other stuff to finish up. But just the last little piece of math, we decided to hold off to today because unit 6 is a big math unit. It's a heavy math unit. Makes sense if we're dealing with the financing side of it. So the last little piece of the math unit is for qualifying a buyer. And the purpose of this math, there's two reasons we go over this math. One, as with the whole unit, you and I need a basic understanding of the lending process. We need to know the very basics of what the lender and borrower are communicating against, because my buyer's coming to me on the regular. I'm the front line. I'm the one that they all, hopefully the one that they trust, that they start with. And so they may come to me with a lender question, or an appraisal question, or some of these other things that we're talking about. So having this basic understanding can better help us understand the process. Of course, also understanding the big pieces when to stay in your lane. But another reason why we go through this is because this is something very real world that you all may need to know one day. A lot of the lenders will look at you and say, I work when you work. So if you need a pre-approval on a Thursday night, you might get a hold of the lender. If you need a pre-approval on a Sunday morning or a Sunday afternoon at an open house, you probably can get a hold of a lender. But remember, I'm going to use the lender that my buyer wants to use. So while most of them say, I'll work when you work, there are a handful that still keep the traditional Monday through Friday, 9 to 5 job. So imagine a scenario where you have a buyer come to you on a Saturday morning. Maybe they're just in town for the weekend. Maybe they just decided Friday night that they wanted to buy, who knows, but they come to you on a Saturday morning and say, I want to buy a house and I have a lender buddy. I know this is who I want to use because we've done deals with whatever relationship in the past. So I know this is who I want to use. The problem is my lender buddy's not in the office until Monday. They're closed on the weekends. So now you have a choice to make. Do you just go out all weekend and show this buyer property and then have them talk to the lender on Monday? To me, that could be a good case, a good scenario for wasting weekend, yours and the buyer's. Or we can have this basic understanding of qualifying a buyer. Once we have this basic understanding, then you and I, after a quick calculation, a couple questions and a few calculations, we can better help this buyer understand if it's worth our time going out this weekend, what's the price range, that kind of thing. So again, qualifying a buyer math is good to understand, but it's also good to know how to use in the event it comes up in the real world. And when we talk about qualifying a buyer math, you can see we're looking at the two different loan products, conventional and FHA. And with these two loan products, there are two pieces, there are two qualifiers. And in order for a borrower to qualify for a loan, they have to satisfy both pieces. You don't need to know these numbers. They're just here just to show us that they are different. I'm going to talk about what these numbers mean next. And we're going to work on the sample problems we use. Your exam is all going to be based off the conventional numbers. Maybe they'll give you the 2836 on your exam. I have a feeling that they will give you the 2836 on your exam, but I don't know 100%. So when it comes to the conventional, I will just go ahead and know that the ratios, the qualifying ratios that we're dealing with are 28 and 36%. So what do these numbers mean? Well, there's two different qualifiers. There's two different things to take into consideration. Let me make this just a little bit bigger for now while we're here. The first thing to take into consideration is that 28%. And the 28% just looks at the borrower's housing payments. And the lender defines housing payments as your PITI, your PITI, principal and insurance, taxes. I'm sorry, yeah, principal and interest. There it is. Principal and interest, taxes and insurance, the four pieces that you mail in each month. Housing payment also consists of PMI. If you have that conventional loan where your loan to value ratio is 80% or more, then you'll have PMI and the lender considers that part of your housing payment. And then you have HOA dues if applicable. So if the property's in an HOA, what are those monthly dues? So the lender looks at the borrower's first qualifying ratio, which is the housing payments, the 28%. And what they're looking for, let's look at pie. If the whole pie represents all of the income, the monthly income that the borrower has coming in, the pie represents the monthly income that the borrower has coming in. And what the lender needs to see is of that monthly income, 28% is allowed to go towards housing expenses. Of everything you make every month, your monthly income, 28% can go towards housing expenses. It's important that we know housing expenses consist of PITI, PMI if applicable, and HOA dues if applicable. If the borrower's housing payment is more than 28% of their monthly income, then they're not going to get loan approval. So qualifier number one, 28% represents how much they can allot for their housing payment. The second qualifier is the 36%. The second qualifier, well, yeah, it looks at the reoccurring, the housing payments. It looks at the PMI, if applicable, the HOA dues, if applicable. and the PITI, the projected monthly payment. And in addition to the housing payment, the second ratio also looks at the 36, the reoccurring debt. So how much debt does this borrower have coming into this? Reoccurring debt includes things like student loans, medical bills, alimony, child support. Do you have another mortgage? Do you have a car payment? You know, those bills we sit down and pay every single month? That is your reoccurring debt. It's money that you already owe, and you're asking the lender to give you more. So they have to take your existing obligations into consideration. And same thing, the pie, the whole pie represents the borrower's monthly income. And the lender says of your monthly income, we can allow 36% to go towards housing a payment and your debt. So the qualifying ratios look at what they want to borrow, what they have, as it relates to the money that they already have coming in. And so in the real world, we can ask a buyer, that buyer that calls you on a Saturday and says, my lender buddy's not available till Monday, but I really want to see 10 homes this weekend. Okay, let's crunch some numbers. What's your projected PITI? We can go to various websites. Most mortgage lenders have some kind of calculator that you can do a quick calculation to see if you buy this house and you're putting X amount down, what would your monthly payment be? So we can help them get a guesstimate of that PITI. It's a guesstimate only, but it gives us an idea. It gives us something to work with. So we're going to ask the buyer, what's your projected payment? What's your existing debt? And based on that, we can determine if it's worth showing them those 10 homes. Or maybe we need to talk to them about price point. Maybe we talk to them about talking to another lender. How serious are you about the one that's not available on weekends when you're out trying to buy a house? So things to think about. I'll be honest, you guys, it's more important to me that y'all understand the 28% and the 36% than it is that we know the math. So let me pause here and see how we're doing so far. The 28% and the 36% are all representative of the borrower's monthly income. Questions so far? Housing payment. Is recurring debt the same as housing payment? No, your housing payment is just these three pieces: your PITI, your PMI if applicable, and your HOA if applicable. Reoccurring debt are all your other bills. So maybe you already have another mortgage. Maybe you're not going to sell that home, but you might have a car payment. You might have student loans. You might have medical bills, alimony, child support. That's your reoccurring debt. So we have to look at the proposed housing payment plus what you already have. So they're two different things. And guys, the reason for these ratios, let's look at this. At the 28%, all you've done, let's just pretend you're not a conventional loan and you're not in an HOA. So the 28% would be your PITI, your principal and interest, taxes, and insurance. Once you make that payment, you've used up 28% of your income. You still haven't put food on the table. You haven't, put gas in the car. You haven't paid for power, internet, right? You still haven't paid some of those bills. All you have done is made that housing payment at that 28%. And so the lender says we have to allow the rest of it for like you to live. We got to eat. We got to put gas in the car. We have to save for a rainy day, things like that. So reoccurring debt and housing payments are two different things. And that's part of why we look at two different ratios. One with just the housing payment, and then the second one with that same housing payment plus your existing debt. So yes. So let's talk about the math piece of it. I can find what I'm looking. Here it is. T-bar fans. We can use a T-bar for this. So when we're qualifying a buyer, we can use a T-bar. And as a matter of fact, when we do qualifying a buyer math, we're always going to use two T-bars because I got two ratios to consider. I got the 28% and I got the 36%. So we're going to use the same T-bar twice, one for the 28%, the other for the 36%. If the borrower doesn't qualify under both, then they're not going to qualify for the loan. They have to qualify under both. So the lender has to take both things into consideration. And as you guys are writing this down, I'll tell you right now, one of the problem topics with qualifying a buyer math are those words monthly. We're only going to look at monthly expenses and monthly income. They like to do fun things to you, like give you annual income. We need to know the formula to know when they give me annual income, I have to divide by 12 to get monthly. They may give you annual taxes or whatever. The key words here are monthly. And part over the whole, we're looking at the borrower's monthly expenses as part of their monthly income. The smaller number goes on top. So presumably, if we're having this conversation, the smaller number is the housing expenses. It's going to be part of, as we just saw in our pie, it's part of their monthly income. And then the qualifying ratio, what we're looking for here is that 28-36%. So this is how we're going to handle qualifying a buyer math. We're going to work a sample on all three of these. I'm going to show you how we solve for monthly housing expenses. I'm going to show you how we solve for monthly income. And I'm going to show you how we solve for qualifying ratio, because any three of these are a good candidate for your exam. So we're going to go through all three of them together. I'm going to give you samples, and then we're going to talk about what's next after that. But step one, as we know, is to have the T-bar. All formulas go on a flashcard. So hopefully you've had a chance to jot it down. Monthly expenses is part of monthly income. Let's qualify some buyers. So the first problem we're going to work together looks just at finding the borrower's qualifying ratio. And it's of my opinion, this first one is the most real world sample that we have. This is what we're likely to encounter. So Henry and Jody call you and say they're considering purchasing a home. Together they earn $93,000 per year. Their estimated housing expense are $1,500 per month, and their monthly recurring debt is $1,600. The question is, would Henry and Jody qualify for a conventional loan using the 28-36% ratio? So we've read the problem, and I may not know what else to do, but I do know for a fact that I'm going to use not one, but two T-bars. So let's go ahead and throw down two T-bars. I also know that this problem is asking me for Jody and Henry's qualifying ratios. And the question is, would they qualify? So these people call you and they say, this is our debt. This is how much house we want to buy. This is what we want our monthly payment to be. And this is how much we make. Based on this, could I qualify for the house that I want to see? So we're looking for Jody and Henry's qualifying ratios. And again, it's of my opinion, this is the most, of the three, this is the real world sample that you might come into. The number on the bottom left is their monthly income. So the problem tells us that together they own $93,000 per year. So we're going to take their annual income and we're going to divide it by 12 to get their monthly income. So every month they bring in, between the two of them, $7,750. Questions so far? Monthly income. Now we got to look at the number on top. And with qualifying buyer ratio, the number on top varies. It's going to be different from one T-bar to the other. The first ratio is our 28% ratio, and the first ratio only looks at housing expenses. Housing expenses are our PITI, PMI if applicable, and HOA dues if applicable. So since we're only doing what the problem gives us, I can only work with what I have. It tells me that they have an estimated housing expenses of $1,500 per month. It doesn't mention PMI and HOA. So we're just going to roll with the $1,500 per month housing expenses for the first ratio. The back fourth line in the T-bar means divide. So we're going to take 1,500, divide it by their monthly income. And I get 0.1935. I'm going to round just a little bit there. Or if I move my decimal over 2 places, I can convert the rate to a percentage, move the decimal over 2 places, and I'm showing Jody and Henry for housing expenses are at 19.35%. Thumbs up or thumbs down? How are Jody and Henry looking so far for loan approval? So far, so good, because they are under the 28%. They are under that lender's threshold, that lender standard of no more than 28% of your housing expenses can go towards your monthly payment. So far, so good. Before you run out and show them 10 properties this weekend, though, remember the lender, they got to qualify under both. So now that we've looked at the 28% for just housing expenses, now we need to look at the second ratio. The 36% is our housing expenses plus their reoccurring debt. So we've already determined that they want housing expenses of $1,500. They come to us with debt already of $1,600. So when we add those together, I get Jody and Henry's housing expenses plus their reoccurring debt. So the number for the second ratio is housing expenses, PITI, PMI if applicable, HOA dues if applicable, plus their debt, those bills that they pay every month. That fourth line in the T-bar means divide. So now we're going to take 3,100 and divide it by their monthly income. And I get 0.4, or when I move my decimal over 2 places, we get 40%. Now, how are Jody and Henry looking? Do not show them 10 properties this weekend. Y'all promise me? Do not show them 10 properties this weekend with this information where it stands. The lender, for the most part, is having this conversation with borrowers. And these numbers, these figures, this is an early calculation, a very early calculation. The lender will straight up ask the buyer, how much do you want your monthly payment? How much income do you have? And what is your reoccurring debt? And the borrower probably responds with about an approximate. So the lender's working with some very loose numbers very early on. Remember, the lending process doesn't really get ramped up until we find the property, until we find the contract. So right now we are in preliminary mode. If Jody and Henry were talking to a lender would have to say, based on your current numbers, you're not going to qualify because you're over that 36%. So what can we do? Well, what's the easy solution? What do we get up and go to work for every day? Make more money and have less debt, right? That's all we got to do is pay off our bills and make more money and we're in. Easier said than done, isn't it? What if we have them look at a lesser priced home? that would have their monthly payment less than $1,500. It might be that the borrower just has to pay down that debt, or they have to work with that number before the lender can approve them. And this is what we were saying last week, that a good lender is going to look at Jody and Henry and say, okay, your debt, that 1,600 debt you have a month, is what is prohibiting you from getting this loan. If you want this loan, then what can we do? How can we work together to get that debt down? So a good lender is going to work with them to make it happen. But where it stands right now, no, Jody and Henry will not qualify for this loan because both numbers have to be under the 28% and the 36%. Questions? Can I erase? So that was us. Let's go back for a second. That was us solving for the bottom right. That was us solving for the qualifying ratio. So now let's talk about us working for the monthly expenses, the number on top. And to talk about that, you got some options. We have formulas that we need to understand the formula. We're going to see this worked out on a T-bar. We need to understand where we're coming from at first. And when we're solving for, the question is going to ask you for maximum payment. What they're referring to is your maximum housing payment. Remember, in the lender unit, with our lender hat on, what we're caring about is that housing payment, that what is being paid to the lender for those housing expenses. So the maximum payment is referring to the number on top of the T-bar. And you can see here, we got several different things. We're going to multiply the borrower's income by that 28%, and that will show us their allowable housing payment. And then on the second T-bar, we're going to multiply the income times the 36%, and then we're going to subtract the reoccurring debt. Remember, the second ratio is housing expenses plus reoccurring debt, and that gives me the 36%. If we deduct the reoccurring debt, then that leaves us just with housing expenses, and that's what the lender cares about. Taking their debt into consideration, now can they afford to pay me? So to do a true apples to apples comparison on that second ratio, once we multiply, then we're going to subtract the borrower's reoccurring debt. For your exam, these are all multiple choice. All of your exam is multiple choice. You're working two T-bars, which means you're going to have two answers. So we need to determine which answer is the right answer. I guarantee you both of them will be a choice in the multiple choice. So we've done the problems, and now we're left with two answers, and we need to figure out how to answer for the exam. And for the exam, I always think of opposite world. When the problem asks you for maximum income, the one you're going to put on your exam is the lower of the two numbers. So when they ask for maximum income, the answer we're looking for is the lower of the two numbers. Put your lender hat on. Which borrower is less risky? The one that has more debt or the one that has less debt? And if we're thinking through the eyes of the lender, it's the one with the less debt, the one with the lower monthly housing expenses. So opposite world. It's asking for maximum payment. The answer you're looking for is the lower of the two numbers. So let's take what we have here and look at a problem. And by the way, I've kept this So we have it with our problem. We can look at it. So you can either see formula or T-bar that we're getting ready to work. Let's first talk about Matt and Kim. Matt's got an annual income of $35,000. Kim has an annual income of $38,000. Their reoccurring obligations are $700 per month. What is the maximum payment they can afford using those ratios? So again, I'm qualifying a buyer. I really don't know what else to do, but I do know staring at a blank piece of paper isn't going to make numbers magically appear. So I'm going to throw down two T-bars and see what I can't do with them. I know what I'm solving for this time is their monthly housing expenses, their monthly housing payment, their maximum payment. So the X this time is the number on top. The problem gave us the ratios. We know the ratios. Again, I'm almost certain they will give you the ratios, but in the event that they don't, I would know the 28, 36% just for conventional loans. And then the number on the bottom left is their income. So Matt makes 35,000. Kim makes 38. So together, they're bringing in 73. That's annual. I know my T-bar, I know my formula, so I know what I'm solving for is monthly. So when I take their annual income and divide it by 12, I get their monthly income of 60,083 and some change. 60833. Questions so far on how we completed the T-bars, how we took the information from the problem and plopped it in a T-bar. The up-down line in the T-bar tells me to multiply. So looking at our 28% ratio first, we take income times 28%, and that tells us their allowable payment, their allowable housing expenses under the first qualifying ratio. Based on this information, their allowable payment is $1,703.33. In other words, if they don't bring in $1,703.33 a month, they're not going to be under that 28%. They'll be over it, and we're not going to get loan approval. Questions on the first T-bar. I just took income times 28%. Now we look at the second T-bar, and the first thing I need to do is work the T-bar. So I'm going to take my monthly income, times it by 36%. The up-down line in the T-bar tells me to multiply. So 6083.33 times 36%. This gives us, I rounded just a little bit. I'll talk about rounding in just a second. So I took my their monthly income times the 36%, and this gives me allowable housing expenses plus reoccurring debt. The second T-bar always looks at both housing expenses plus reoccurring debt. And we have a number here, but the lender's saying, you know what? I've just figured in the reoccurring debt. We just calculated it by looking at that second T-bar. But when it comes down to actually issuing the loan, I need to see which one is less risky. And since the lender cares about their numbers, we need to do an apples to apples comparison to housing expenses and housing expenses. So now that we have the second ratio, the housing expenses plus reoccurring debt, the next thing we need to do is deduct that reoccurring debt. The problem tells us that the reoccurring debt is $700. So when I deduct that, I have housing expenses only of $1493.60. And now the lender can do a side-by-side comparison of housing expenses in the 28% versus housing expenses in the 36%. Opposite world, if we're looking for the maximum payment, I want the lower of two numbers. So you can tell me option number one is the 1703. Option number two is the 1493. Which one are we going to get approved on? Which one are Matt and Kim going to get approved on? One or two? Yeah, number two, because it's the lower. They have less housing expenses in that ratio. It's the lower of the two. Again, put your lender hat on. I owe you money. Which one is less risky? If I have $1493 in expenses or $1703 in expenses? And what they care about is the less risky. The lender's going to care about the less risky. So in this case, Matt and Kim's allowable housing payment is $1,493.60. Anything over that, they wouldn't get loan approval. Questions? Can I erase? Let's see, where did I get the 700? The 700 came to us from the problem. It tells us their reoccurring obligations are 700 per month. So the problem's got to tell us what their debt is. The problem has to tell us some of that information. Anything else on this one? One more. The last piece then is to look at the borrower's minimum income. So again, we're going to work two T-bars. We're going to see two ratios. You got two formulas that may or may not help one way, however you see it. Housing expenses, we're going to take those monthly housing expenses, PITI, PMI, and HOA dues if applicable. And now we're going to divide by 28% to get minimum income. For the second T-bar, we're going to look at the housing expenses plus the reoccurring debt. Divide that by 36% to get the borrower's minimum income. This takes into consideration how much money you need to make each month to not only pay the debt you already have, but also your proposed housing expenses. How much are you wanting to borrow? Again, the lender needs to make sure that you can afford to take on new debt. In addition to what you already have, can you take on housing expenses as proposed monthly payment and still be able to fall under that 36% to pay your bills and live? These problems, so let's see, question came in, if they listed more debt, we would have to subtract that too. Yes. Yes, the previous problem just gave us a 700, but they might break it down. They might say car payment is X amount, child support's X amount, which case we need to add it up. Mostly how I see it though, they just give you that one number. Keep it simple. Thank you. Good question. So minimum income, again, the question's going to ask you for minimum income. And once again, I want opposite world. We're going to work two T-bars, which means I'm going to have two answers. Both of them will be multiple choice. Both of them will be candidates on your exam. So the question is, which one do you choose? And when the question's asking you for minimum income, I'm looking for the higher. Again, put your lender hat on. Which borrower is less risky? The one that makes more money or the one that makes less money? And through the eyes of the lender, it's the one that makes more. Low expenses, high income. This is what makes the lender happy. Low expenses, high income. So let's talk about Charles and Hannah. Charles and Hannah want to buy a home with a PITI of $1,900 per month. They're going to have PMI of $60 per month because they're getting a conventional loan. And they're buying in a place with HOA dues that are $50 per month. They come into this with reoccurring debt of $1,100 a month. Question wants to know what's the minimum income they need to qualify for this loan. They're looking for a very particular home, $1,900 per month, conventional loan with PMI, HOA dues. They're looking at a very specific home. And the question is, do they make the income? What is that minimum income needed in order for them to qualify for both? So again, I don't know what else to do. But I do know when I qualify a buyer, I need to use two ratios. And I do know this one is asking me for monthly income. So I know that's what I'm solving for. And we're going to base it off of the qualifying ratios, 28 and 36%. So now let's look at the first ratio. The first one just looks at housing expenses. So we have housing expenses. I got a PITI of $1,900 per month. We got PMI of 60 per month. And we got HOA dues of 50 per month. Again, you guys, please make sure you're reading these problems carefully because they like to say stuff like annual taxes and annual HOA dues. So just make sure we're always talking in monthly verbiage. So when we add up their housing expenses, their PITI plus their PMI plus their HOA dues, I get $2,010, just their housing expenses. Let's finish this one out since we have it right in front of us. That fourth line on the T-bar means divide. So we're going to take their housing expenses, divide it by 28%, and that gives us, put this over here maybe, divided by 28%. That gives us their allowable monthly income under the 28%, under the housing expenses. So just looking at their proposed housing expenses, this is the house we want to buy. Can we afford it? And the lender's going to say, based on the information you gave me, as long as you make $7,178.57 a month, when looking at the 28% ratio, so far, you're good to go, assuming they make that much. But the lender's got to look at both. So now the second T-bar. We're going to take, for our reoccurring debt, we're going to take those housing expenses that we just calculated, and then we're going to add in the debt that they already came with. So 1,100. So I got reoccurring debt, their housing expenses plus their debt gives us the number for the second ratio. So I took their housing expenses plus their reoccurring debt. And we got 3,110. Back fourth line in the T-bar means multiply. So I got 3,110 divided by 36%. Now I'm getting an income. Let's see, 8.8. There we go. So I'm looking at housing expenses. I got a monthly income of 71.78 and some change. And looking at housing expenses plus reoccurring debt, I got 86.38 and some change. Number one is 28%. Number two is 36%. Show me which one are they going to qualify under? Which one is less risky to the borrower? I'm sorry, to the lender. Which one is less risky? And the answer is the higher of the two. Which one is less risky? The borrower that makes more money. The lender wants to see more money, less debt. So opposite world tells us when we're looking for minimum income, we want the higher the two numbers. So the answer you're looking for on your exam is the 86.38.89. If they don't make that a month, they're not going to qualify for this property. Maybe we take them out and find them a property that doesn't have a HOA. Maybe we take them out and find a property with a lesser PITI payment. Maybe they pay off their debt. It's not over yet. I just can't work with them. The lender can't work with them if they don't qualify. And this is why we do this very, very early, or they do this very early. Questions, minimum income. Y'all want some good news? Who could use some good news on this rainy, cloudy morning? You're not going to see qualifying a buyer math on my exam. So I don't want you guys worrying about this yet. Make yourself a note right now that on September 30th at 9 a.m., find the recording. And when you're getting yourself ready for the state exam, I suggest you come in and review qualifying a buyer math. If you get it, it could be a test question. If you don't, it's okay. It's just one test question. Remember, if you can get some of the math, you don't have to get all of the math. You may or may not see this on your state exam. But I'm in a good mood today, and I'm telling you, you're not going to see it on our end of class exam. Is that good news? Good news. Questions?
Are there like exceptions to these rules? Like, let's say you're retired or you're unemployed, but you have savings. Like, I feel like,
Absolutely, Eli. This
yeah,
is just scratching surfaces, and we're not going to take away from the lender's job. So if I have, maybe I just sold a house and I have $100,000 laying around. Doesn't that make a difference? Doesn't that impact? Doesn't that mean something? And the answer is absolutely. Retirement, you still may have money coming in, you have savings, Social Security, Medicare. Every single borrower is different, which is why the lender needs to look at. So we're just kind of introducing you to the basics here. Anything else? Can I erase? What a great time to take a break. So let's take 10. When we come back, we're going to finish up the non-math piece of Unit 6. Welcome back. I am going to take attendance. We are done with math for this unit. I still got other math, but we are done with financing math. So there's the good news. But some other things to talk about, some of the stuff we've already hit on. So that'll be good. It's always good, I think, to kind of hear it again. Some more to discuss with the lending world. Put our lender hat back on and think through the eyes of the lender, that basic understanding of how this works. And now in this section, we're going to talk about the different mortgage markets. There's the primary, there's a secondary, there's the one you and I talked to. So we're going to look at the lending market world and how that works. And then we're going to talk about somebody called the Consumer Financial Protection Bureau. So how that came to be, what we do it for today, and it's just exactly how it is. It's a consumer financing protection. So it's out to protect the consumer when they're getting financing. So how that came to be, a little history on that, where we are today. And we're going to learn that Consumer Financial Protection Bureau gets us into something called TRID, which consists of something called RESPA and the Truth in Lending Act. So we're going to talk about some lender laws, which is what we're looking at with TRID and Consumer Financial Protection Bureau, that kind of thing. Various lender laws to be aware of. And then we're also going to talk about the lenders protected classes. So in the lenders world, they call them Equal Credit Opportunity Act. And we're going to see how the lenders protected classes compare to our federal fair housing, and then talk about the Credit Reporting Act. So a background, a basic understanding, a background understanding of the lending world and some of the laws that they have to follow and what it means to us. So let's talk first, talking about this lending market. And with the lending market, it kind of answers the question, how money moves. When you march into a bank to borrow, 200,000, whatever, for a loan, the lender's got to get that money from somewhere. Nobody, I don't care who you are, nobody has an endless supply of money. The money has to come from somewhere. So when you borrow money from the lender, one of the first things in the back of the lender's mind is, well, how are we going to get the money to lend them? And that gets us into this lending market, how all that works. And to better understand the lending market, we need to talk about the 3 tiers of the lending market. And the top tier number 1, are the feds, the Federal Reserves. The feds control the supply of money in the economy, not just specific to real estate. They control the supply of all the money floating around in our economy and adjust that supply of money as necessary. A big chunk of the money floating around in the economy is the money for real estate. I mean, just by nature, think about some of the price tags on some of these homes. So a big chunk in this Federal Reserve is in the real estate industry. The feds may loan money directly to the lender. One possible source for lenders to get their money is to borrow it from the feds. Shake your head yes or no. If the lender borrows it from the feds, is the feds going to charge them interest rate to borrow money? You better believe it. And that's part of what gets passed down on to us. It costs them to get money, and part of their cost to us is paying their bills. So one option, not the only option, but one options that lenders have to get money is to borrow it from the feds. That's our first tier. The second tier in the lending market game is the primary mortgage market. The primary mortgage market is who you and I talk to when we want to borrow money to buy a house. The primary mortgage market are our lenders. So Bank of America, Wells Fargo, Movement Mortgage, Fairway Mortgage, etc. They are a player on the primary mortgage market. I want to buy a home. I go to them. They give me a loan, and look at happy me over there. Yay, I get to get my loan. I get to buy my home. As mentioned, one place that the primary mortgage market gets their money from could be from the feds. Another place that the primary mortgage market might get their money. Let's say, for example, they have a supply of money. They have so much money that they can lend out, and they give me a loan and they give two other people a loan. Their supply of money is out. They have no more money to lend. So now they got to figure out where are we getting it. And they got two choices. They either borrow it from the feds or they sell these loans to the third tier in the lending market, which are players on the secondary mortgage market. So the primary mortgage market can sell their loans to the secondary mortgage market. The secondary mortgage market's job is to buy loans. That's what they do. So you and I are not talking directly to them. The secondary mortgage market is who's talking to our lender. We're talking to the primary lender. So they gave you, and you alone. They have no more money. And one way they can get money to issue new loans is to sell your loans to the secondary mortgage market that replenishes their funds. And now they have more money to loan. It keeps money flowing in the economy. A lot of times, my homeowners on the call, there's a really good chance that whomever you're sending that monthly payment to every month is not going to the lender that originated your loan. Lenders are either in the job of originating it. As soon as you close, they're on the market to sell it, or the lender may choose to keep it in-house. If the primary keeps it in-house, and they are going to service it, and they are not going to sell it to the secondary mortgage market. Some lenders sell it, some lenders keep it in-house. You'll meet them all. Remember, we're always going to encourage our buyers to shop around. So the secondary mortgage market replenishes the funds to the primary lender. If they choose not to buy it from the feds, their other option is to sell it to the secondary mortgage market, replenish their funds, and that allows them to issue new loans, to originate new loans. The players on the secondary mortgage market, you've probably heard of. Heard of Fannie Mae? Maybe we've heard of Freddie Mac and Ginnie Mae. These are the players, and Wall Street. These are the players in the secondary mortgage market. These are the ones that buy loans from lenders. And by buying loans from lenders, it replenishes their funds. So bottom line, you guys, lenders don't have some kind of money tree out back that when you borrow a 200, they just can't go back and pluck a $200,000 bill off the tree and say, here you go. They got to get that money from somewhere. They either buy it from the feds or they sell it to a member on the secondary market. Questions on the lending market process? Let's talk about some lender laws. They have their own set of laws. Lenders have to go to, lender school. They have to pass a test. They have to take a state exam. The similar process before they can start originating, issuing loans. And they also have a set of laws, like we have license law and commission rule. They have sets of laws that they have to follow. And while you and I don't need to know all of them, we do need to know the ones that are applicable, that apply to us on the broker level as well. So one of the bigger lending laws that you're going to come across is something called TRID. 2008, 2009, 2010, in that area, it was a bad time for real estate. We were going through something called the housing market crash. Foreclosures and short sales were the norm. The housing market was crashing, or it had crashed. And there are a cajillion theories out there about what caused the housing market crash. And we're not getting into all those theories, but one of the more popular theories was fraudulent lending practices. Some lenders, y'all, before the housing market crash, some lenders were giving loans away like Oprah. You get a loan, you get a loan, you get a loan, everybody gets a loan. There were some lenders that were issuing loans because the buyer called and said, this is how much I make, this is my debt. And based on the phone call, they weren't verifying it, they weren't crunching the numbers themselves, just based on what the buyer said, they were giving out loans. Not all lenders are fraudulent, not all lenders are bad. Same thing applies today. There's a bunch of good ones out there, but it was the bad ones with questionable practices that part got us into where we were in the housing market crash. So as a result, we came out on the other side of the housing market crash with new lending laws. And the big one we got was in 2015, and it was TRID. TRID is the acronym of all acronyms. The T in TRID stands for TILA. TILA is the Truth in Lending Act. TILA's always been around. It's nothing new. The R in TRID is RESPA. RESPA stands for the Real Estate Settlement Procedures Act. RESPA is nothing new. TILA's always been around. RESPA's always been, well, since about the early 70s or so. They've been around for a while. They're not new. What TRID did was integrated them. TRID combined them. So TILA and RESPA have always been, or at least as far as we can remember. And what TRID did was combine them. They integrated them. So we're going to talk a little bit about both, but the big picture here is what TRID does today to protect the consumer. I want you to see a couple things with TRID, or excuse me, with TILA and RESPA. And even though they're all integrated today, they still do two different things. When you guys see TILA, what I really want you to see is the word lending. TILA tells the consumer the cost to obtain the loan. How much is it going to cost me? Origination fees, lender charges, credit report fees. What is it going to cost me to get this loan? So when we see TILA, what we're really going to see is the word lending. When we see RESPA, what I really want you to see is the word settlement. And we're going to learn that settlement is part of closing. RESPA tells the consumer the cost to close. So TILA says this is what it's going to cost you to get the loan. RESPA says this is what we're going to cost you to close. The two of them now work together. They are integrated. And one of the big things that came out of the housing market crash was that borrowers weren't aware of their numbers. And so now for the lenders, they have this major duty to disclose these fees, disclose the fees to get the loan, disclose the fees to close. So just a little history lesson here. We're not going to get too bogged down in this, but just so we've seen these things. It all started, housing market crash, Dodd-Frank, financial reform stepped in and said, yeah, we got to do something because we can't have this happen again. I mean, we're an economy. In economies, we can expect highs and lows. Real estate is an economy. It's in a market. So we can expect highs and lows. But the hope is we don't get housing market crash low again. We hope not to get that low. So Dodd-Frank stepped in and said, we're going to ramp things up. We're going to combine TILA and RESPA and call it TRID. We're also going to set some other criteria, mostly about disclosure criteria for fair credit reporting and our equal credit opportunity, the lender's fair housing. And one of the bigger things that came to be from the housing market crash is the CFPB. or the Consumer Financial Protection Bureau. We got a whole division now set aside to protect the consumer when they're originating a new loan. And again, a big piece of it is disclose. Let the consumer know what it is that they're borrowing. Before the housing market crashed, I was still an administrative. I wasn't doing sales, that piece of it yet. I was still an admin. And I remember my agents coming in to the office. And I remember sometimes where they would say, the buyers didn't see their final numbers. They did not see their final monthly payment every month for the next 30 years until they were sitting at the closing table. Did that just make your heart flutter a little bit? You're getting ready to make a 30-year commitment for X amount, and you don't see that X amount until you're like handed a pen and say, sign here. They weren't seeing those numbers. They didn't have time to think about, to consider those numbers. And the CFPB stepped in and said, guys, we can do better. We can disclose the information. So again, what came to be from all of that is the lender law of TRID. Keep in mind, TRID is a lender law. There are some pieces of TRID that affect us. So we'll talk about the broker piece of it. But it's important that we have an understanding. Again, you know, we're kind of like we're the ones that are keeping the gears going. Imagine a system of gears. If the lender has a gear and the attorney has a gear and the agents have a gear and the buyer and the seller, everybody's on a gear. We know what happens when one of those gears stop and the whole daggone process stops. So a big part of my job is keeping those gears going. And that includes on the lender side, being familiar with what's going on so we can keep our buyers on track. So let's talk about TRID. Specifically, a little bit about RESPA. RESPA applies to federally related residential mortgage loans. If it's a commercial loan, if you're buying a commercial property, RESPA's not around. The TRID doesn't apply. So it doesn't apply to all. Y'all watch the words on your test. RESPA, TRID don't apply to all loans. They only apply to federally related residential mortgage loans. By the way, federally related are our conventional FHA, VA, USDA. They're all backed or supported or have something to do with the feds. And then RESPA only applies to 1 to 4 family residents. So if you're buying a 5 or more unit, think of an apartment building, then RESPA, TRID aren't around. Also, and this is a problem topic in the real world, so let's squash it before we get to the real world. RESPA is a lender law, which means if it's a cash buyer, there's not a lender involved. So if it's a cash buyer, there's no lender. The rule is there are no rules. Lenders or TRID is only around when a lender is around. I have agents, once we better understand TRID, there are certain things that TRID says the attorneys and the lenders can and can't do. Let's get into that a little bit. And I have agents all the time coming to me after a closing. You're not going to believe it. And the attorney let buyer and seller sign in the same room. Well, pre-TRID, that was fine. Post-TRID, TRID wants them separate. They want the seller to sign in a room. They want the buyer to sign in the room. They don't want the two together. More on that. So my agents come in. They were in the same room. I need to call. Who do I call? And my first question is, was it a cash buyer? Well, yeah, it was a cash buyer, but... And I just smile sweetly and wait for them because I know they know. They're just all in the heat of the moment right now. So cash, no lender. We have no rules. We have no lender laws. Disclosure is a big piece of it. So RESPA, TRID. RESPA used to have their own documents. TRID or TILA had their own. And one thing they did when they integrated was they integrated the documents. So today, we don't need a history lesson on that. Just know that there used to be like duplicate paperwork. TILA had forms and RESPA had forms. So today they've combined them. And today what we have is a loan estimate and a closing disclosure. We're going to talk more about each. But the loan estimate is going to be sent to the borrower within 3 days of loan application. So once the lender has a completed loan application, the lender has 3 days to send the borrower the loan estimate. Note that word estimate. It is just that. We're not giving final end all be all numbers. We don't know yet. Presumably, we just went under contract 3 days ago. But what we can give is an estimate about what are those numbers, about what is your monthly payment, about what is your taxes and insurance, etc. When we get to the end, TRID and RESPA are required to provide a closing disclosure, also known as a CD, and they require 2 CDs, one for the buyer and one for the seller. TRID doesn't want the seller to see the buyer's numbers. TRID said it is none of the seller's business what the buyer's numbers are, what their loan numbers are, their interest rate. It is none of the seller's business. Now, I just said something you might have picked up on, so let's go back and address it. I said TRID doesn't want the seller to see the buyer's numbers. TRID doesn't want the seller to be at the closing table at the same time as the buyer. When we're talking about TRID, the consumer that we are protecting in this transaction is the buyer, is the borrower, because they are the ones that are originating the new loan. Maybe the sellers have a loan already. We're not protecting the seller in this transaction because they're not getting a new loan. So when we talk about the consumer in TRID, the consumer we're referring to is the buyer, because they are the ones that are originating the new loan. So a lot of the secrecy, they really could care less if the buyer sees the seller's numbers. What we have to protect is the seller from seeing the buyers. So we have 2 closing disclosures. They both work a little different, do different things. We're going to have a fuller conversation on the loan estimate and the closing disclosure when we get to Unit 11, because that's our closing unit. So we'll see more on both of those. Right now, we're just talking about the lender requirements. So we said the loan estimate, the lender has to send that out within 3 days of loan application. They also have a deadline for the closing disclosure. The lender must send the borrower the closing disclosure no earlier than 3 days before settlement. 3 days. And we will talk about days. We will talk more about that. But lender requirement under RESPA. Loan estimate has to come out within 3 days of loan application. Closing disclosure has to come out within 3 days prior to closing, prior to settlement. This gives the buyer to review their numbers. This gives the buyer time to absorb that monthly commitment for the next 30 years, instead of hearing it for the first time sitting at the closing table with somebody thrusting a pen at them saying, just sign here. Another thing that RESPA does to protect the borrower, protect the consumer, also within 3 days of loan application, the lender's now required to send the borrower a know before you owe booklet. This usually comes over in a digital format. And the know before you owe booklet explains the lending process to the borrower. It lets them know what to expect. It encourages them to shop around for lenders. So it's all about, or this part is all about educating the consumer on their new loan. What do you need to know before you take on this 30-year commitment? Other things that RESPA and TRID do. They're going to put escrow account restrictions on the lender. So last week we talked about that monthly payment and 1/12 of your taxes and 1/12 of your insurance this amount this year. So 1/12 of this year's tax bill and 1/12 of this year's homeowner's insurance. As part of what you pay in each month. When you make that payment, they take that 12th and they put it in an escrow account for the borrower. And every month they take that money and they put it in the escrow account. And at the end of the year, when your payment comes due for taxes and insurance, they have that money to pay on your behalf. With that being said, RESPA regulates how much the lender can collect. You hear me say things like a 12th of this year's tax bill, because RESPA says that's all the lender can collect. They cannot collect more than this year's tax bill. Next year, when the tax bill is more, or when the insurance bill is more, they can recalculate that. They can adjust your payment. But one of those escrow account restrictions is on how much they can collect each month. They're regulated on that. The other piece of that is when you originate the loan, when you close on your home, they have to build your escrow account. So it's not uncommon for the lender to require a month or two payment to collect at closing as part of the buyer's closing costs. They can collect a month or two of escrow to fund the account and also to have a little bit of cushion. Because like we're saying, there's a good chance taxes are going to go up next year. There's a good chance that insurance is going to go up next year. So if they can collect a little bit up front, then they have that cushion for when those bills go up, they can still pay those on behalf of their borrower. The money in the lender's escrow account is the borrower's money. I never want you guys to think that they're taking it. They're holding it to use on behalf of the borrower. If you ever sell a home with a loan, or if you pay that loan off, once it's all said and done, if you have anything left in your escrow account, bills are paid, everything's said and done. If you have any money left, you're going to get it back. They're not taking your money. They're using your money to pay those bills on your behalf. I got a little condo. We paid that condo off several years ago. And that was a good day, by the way. And about 3 weeks after we paid off the condo, I walked out to my mailbox and I had a check in the mailbox made out to Julie Campbell. That's nice. That's a good day, y'all. The check that I had 3 weeks was the surplus that I had in my escrow. So once they finalized it, once they calculated it, they gave me that money back. So lenders are regulated on this escrow account that they have for their borrowers to pay those bills on their behalf. Disclosure of loan servicing. Loan servicing is referring to who's going to service the loan. Is the lender going to keep it in-house and service it themselves? Or are they going to sell it to a player on the secondary mortgage market? Are they going to service it themselves, or are they going to sell it? Lenders are required to disclose their intention. And then another thing RESPA did, they prohibited kickbacks and referral fees to or from settlement service providers. And my future brokers, this is the one that hit us the hardest. I remember when this came out, agents across the country were mad. Life used to be good for us settlement service providers. First off, let's talk about who is a settlement service provider. And that's just anybody that provides a service during the settlement process. The broker, the attorney, the lender, the inspector, the surveyor, the appraiser, all those people that are part of the contract to closing process or settlement service providers, including me and you. Life used to be good. I could recommend my buyer to a home inspector, and as a thank you, the home inspector could send me a, $25 Amazon gift card. I send enough buyers to this home inspector, I'm racking up on Amazon gift cards, aren't I? There were stories of lenders, y'all brace yourself for this. There were stories of lenders, none that I knew. There were stories of lenders. If you sent a buyer to this lender as a thank you, they would put your name in a hat. And at the end of the year, they would draw from the hat, and the winner would get an all expenses paid cruise. That ship has sailed. Ba-dum-bum. Okay, let's talk about this for a second. Why am I sending my buyer to this lender? Why am I sending all? Let's be honest, y'all. Why am I sending my buyer to this lender? Is it because they're the best one in the game? They're the best one for my buyer? Shoot, no. I want to go cruising. And the more I send, the more I got a chance to win. Everybody with me? Was that in my buyer's best interest? I don't care about this lender's product. I don't care about what they do for you. What I care about is I want my name in the hat to go on a cruise. Can we see the conflict of interest? Huge conflict of interest. So RESPA stepped in after the housing market crashed and they said, no more. You can't give or receive. Please make sure you make note of that. To or from. Somebody might try to hand you a gift card and you need to be careful and you need to say, no, thank you. I can't take that. This helps keep me and you from making sure that we're not sending our buyers to people for the wrong reasons. We're sending them to lenders because we believe that they work the best with the buyers. We believe that this home inspector is the one that I've had good experiences with. And also as a result of this is when we stopped saying, you're going to use this lender, you're going to use this home inspector. I used to direct people to tell them who to use so I could get the kickback. Today, what we're hopefully saying is, here's a list of 2 or 3 lenders for you to choose, you to shop around, and you decide who can offer the best product. Now, I do have something to add, but let me see if I have any questions real quick. Make note on that referral fee. That's more referring to the kickbacks. RESPA has not touched agent to agent referral fees. So if you're sending somebody to another state, you absolutely can collect a referral fee. Agent to agent referral fees are still allowed. What we're trying to eliminate are those thank yous. Thank you for choosing me. Thank you for using my services. Today, all the lender can do is say just that. Thank you. Now, when you guys get in your industry, when you get in the real world, you're going to have service providers come by the office. They might leave a box of donuts and a stack of business cards. They love to bring us donuts. I hope y'all like donuts. You're getting into a good industry if you are. So they're going to bring a box of donuts and a stack of their business cards. They're going to say, hey guys, help yourselves to a donut. If there's anything I can do, let me know. I look forward to hearing from you. They can still do that because they're allowing all of us to take a donut. What they can't do is come into our office with a box of donuts and say, and you get a donut because you sent me business last month. If you want a donut next month, send me business. They can't do that. If they're going to do something for one of us, and they need to provide for all of us. They can't reward us for sending them. And actually, RESPA says, I can't receive $1 or a donut for recommending services. What thoughts or questions do I have on that? bit more about TILA, Truth in Lending Act. First off, I would know that TILA, another word for TILA is Regulation Z. I would know that TILA is also known as Regulation Z. Fun fact, RESPA is also known as Regulation X. TILA is Z, RESPA is X. And TILA, when we see the Truth in Lending Act, what we see is the word lending. So that tells the consumer the cost to obtain the loan. The lender's got to be upfront about their fees. They can't have hidden fees, hidden charges. They've got to be upfront about all of their fees. TILA requires the lender to disclose if there's a prepayment penalty. When we get to 11, Unit 11, we're going to look at a sample loan estimate, a sample closing disclosure. And we're going to see one of the lines, pretty big print, big bold print is there a prepayment penalty? Yes or no? So we're disclosing these fees. TILA requires the lender to disclose fees, lender fees, the cost to obtain the loan. Another big thing that TILA does for lenders and us is it regulates advertising or marketing, how the lender can advertise their loan product, what they can and cannot say. So Regulation Z, one of the biggest things it does for us is it impacts our marketing. And if I am disclosing loan information, then I too could be found in violation of TRID. You don't have to be a lender to get in trouble with TRID. So if I, the broker, and running around, maybe I'm disclosing in my ads, I'm telling everybody on my social media, hey guys, I got this great new lender. Here's his rates. Here's his numbers. Give me a call and I'll get you in touch with them. I have marketed, I have violated TRID. So we need to be aware of TILA's marketing, because you and I are going to be doing a lot of marketing. You and I are going to be working with lenders a lot. And the big thing that we get from Regulation Z, the big thing to always avoid in our ads when dealing with the loan terms, is we got to avoid something referred to as trigger terms. Avoid trigger terms. A trigger term is when a specific number about the loan is given in an ad. I'm going to say that again because it's really important. A trigger term is when a specific number about the loan is given in an ad. Numbers about the loan may include the monthly payment, the down payment, number of payments, etc. So can we, and we're going to see some examples, of course, in just a second. But right out the gate, can we see the difference? Do we hear the difference in the lender advertising low down payment versus zero down payment? Did we hear that specific number? Did we hear that trigger term? Think about this, you guys. If the lender advertises a specific number, if they say zero down payment, they're implying that this loan is a one-size-fits-all product. They're implying that no matter what your credit score is, no matter what your loan history is, you can get this loan with zero down payment. We got to avoid those specific numbers because the truth is, when it comes to the lending world, none of us are created equally. We all come into this with different income, with different debt, different down payment. We all have a different story. So lenders have a duty to avoid these specific numbers about the loan. And if they do advertise a specific number, if they do hit a trigger term, if they say one, they've got to give you all the terms of the loan because they are promoting a one size fits all product. So if they say 0 down payment, they have to say it all. This is exactly how much your monthly payment would be. This would be your interest rate, your finance charge, how many payments, and the term of the loan. If they disclose one in the ad, they've got to disclose all of the terms. And make a note, the annual percentage rate is not part of financing charges. We're going to talk about that just a little bit. So trigger terms, when you say, and we're looking for specific numbers, and this is what I really need you guys to hear me say, specific numbers about the loan. Is the list price about the loan? How much is the home listed for? Does that have anything to do with the loan? No. HOA dues are not about the loan. This is why because guys, this is what you guys do on your test. You see a question about TILA, you see a number, says property is listed at 350,000. You go, oh, they hit a number, they violated TRIGA, they violated TILA. It's not the listing price. It's not the HOA dues. It's not any seller financing or seller concessions. It's numbers that are specific about the loan. So these financing charges roll in loan origination fee, interest, your discount points, loan assumption fees, etc. So when we talk about finance charges, I'm going to go back for 1 second. When we talk about financing charges on this screen, this is what we're referring to. Talking about closing fees, legal fees, credit reports, title insurance, these are not financing charges. So specifically with financing charges, that loan origination fee, discount points, interest, and the loan assumption if it's an assumable loan, if it will be assumed. Our commission, you might see your commission advertised. A flat fee. Commission is not about the loan. The other thing we mentioned was that APR. APR shows the true cost of credit because it's not just, it takes into account the interest rate, which is important, but it also takes into account all the other costs as well. So the APR, I mean, the interest rate gives us an idea about your payment, but the APR gives the consumer and the lender a more accurate picture of the big picture. The big picture. It incorporates all that. And the APR is not a trigger term. So the lender can advertise the APR and not hit a trigger term. Trigger terms, and I'm going to go back again. Trigger terms are numbers about the loan. Do you guys have this jotted down in front of you? Do you guys hear me? Do you guys have any questions so far? So again, it's the difference in the lender saying, buy your home by the end of the year with a low down payment versus buy your home by the end of the year with 0 down. What we're doing or what they're doing is telling the consumer that anybody could buy a home, anybody could qualify with 0 down. And that may not apply to all of us. Again, we all come with a different credit story. So we're all not going to apply for the same loan. You know, if we really wanted to have some fun this afternoon, we're not going to, but if we really wanted to have some fun, all 29 of us on the call this afternoon, we could all call the same lender and apply for the same loan to buy the same property. And I guarantee you, we would all walk away with different interest rates, with different terms, because we all have different credit. We all have different down payment amounts. And hitting these specific numbers implies to the consumer that we're all created equal, that it's a one size fits all. And in the lender world, it's not. So low down payment is okay. Zero down payment, you've hit a trigger term, and now the lender has to disclose all of the terms of the loan. Questions? So y'all get your chats ready. Let's look at a couple ads. Tell me in a chat which ad would trigger regulation Z? One or two? Which one hits the trigger term? Let's see what we got. We got two ads. And we're seeing which one is the violation. It violates because it hits a specific number about the loan. So ad number one says, I got a great home for $200,000. Is that about the loan? No. Again, just because you see a number does not mean we're going to get excited. And I think that's where we get this one wrong on our test, because we hit a number and it's a number, and it's got to be about the loan. So I got a great home for $200,000. My HOA dues are $100 per month. Again, HOA dues are not about the loan. We got taxes. Again, not about the loan. We just learned that the APR is not a trigger term. So we can, or the lender can promote the APR. And then we got to call John Jones. And then I got a second ad, great home, HOA dues. Here it is, 100% financing available with payments as low as $1,500 per month. Now we're going to call Jane. Which one hit the trigger term? Number two, because we hit specific numbers about the loan. Does everybody see that? Questions on that? The 100% financing is a specific number. They could say low financing. With payments as low as $1,500, they could say low monthly payments. They speak in general. They can't hit specific numbers. Questions on why number two is the violation? Bonus question. There is something wrong with number one. Who could tell me what that is? We just said it didn't hit a trigger term, so it's cool there. But there is something wrong with number one.
They specify the taxes amount.
We can talk about the taxes. That's okay, because that's public information. So we could go to Guilford County and look up those taxes.
Would it be the payment? Because you can't know what a client's going to pay for a house, right?
Number one doesn't give us a payment. It
Okay.
just tells
that-
us HOA dues.
The APR.
The APR is allowed. The APR is not a trigger term. Haha, I'm starting to
The
see.
name of the brokerage is not on there.
There it is. Number one is a blind ad. Good job, you guys. A blind ad says that we're advertising a property for sale without listing who is selling it. Remember, it's not John Jones's listing. It's John Jones's firm. So in addition to contacting John Jones, somewhere in there we need the firm. Number one, what's wrong with number one is it's a blind ad. Very good, you guys. Questions? Make a note. APR is not a trigger term. APR is allowed in an ad. Okay. It's break time. Let's take 10. We come back. We're still in the wonderful world of Tilla and Trid. We're back. Are we back? Cameras are on. We're going to take attendance. Okay. So those trigger terms. Uh-oh. I might have just gotten kicked out. Am I kicked out? You guys are here? Okay. Okay, good. Good, good. All right. So again, trigger terms. Let's go back. Specific numbers about the loan. So HOA dues, list price, taxes, APR are not considered trigger terms. When you get into down payment, monthly payment, number of payments, even saying a 30-year loan, monthly payments for 30 years still tells you that's going to be, 12 payments over 30 years. So information about the loan and what's causing this is the lender has to speak in generic terms when they're talking about their loan. They want to put enough information out there for the consumer to contact them to find out more, but they need to be careful that they don't put out so much to give that implication that everybody could qualify for this loan. And that's why if they do hit one trigger term, they have to disclose all of the terms because now they're advertising a one size fits all product. TILA also has some exemptions. Again, it only applies to residential loans. May apply to some seller financing. I think a good rule of thumb is if it's a residential loan, it's going to fall under TRID. It's going to be covered under TILA and RESPA. Like I said, commercial loans, business loans, things like that don't fall under there. So we're looking for residential loans only, 1 to 4 units. All right, so gee, Julie, what's the big deal? It's only an ad that says 0 down payment, or it's only a $25 gift card from the home inspector for sending them services. What is the big deal? Bam. How's that $25 Amazon gift card looking now? How's that possibility for a free cruise looking now? How's it looking now? It's pretty tight. You could be facing fines. And yes, even though we're not lenders, even though we're brokers, we too could be facing these fines if we violate TRID, specifically the lender laws and TILA. Another reason why you guys, especially you guys getting started, remember the BIC, 3 A's and 2 T's of their responsibility. And one of those A's is advertising. And the BIC's looking for a whole lot in your ads before they go out. And if any numbers hit. What about another scenario? Let's say you get a really nice listing. It's a really nice listing in a very nice part of town. Maybe it's not quite 7 digits yet. Maybe it's up there. Maybe it is. But you decide with your really nice listing that you want to hold a broker open. You want to invite the real estate agents of your MLS to your open house so they can come in and preview your listing and offer you feedback and see if they have any buyers. So you decide you're going to hold a broker open. You're going to do it on a Thursday afternoon. You're going to do a wine and cheese. Doesn't this sound lovely? So to help you with your broker open, you're going to go to your lender buddy. You're going to have a lender buddy. And you're going to go to your lender buddy and you're going to say, hey, do you want to do this with me? And the lender buddy's probably going to say yes, because what a great opportunity for the lender buddy to meet other agents. So your lender buddy very well may say, sure, 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 I'll do this with you. I'm looking forward to it. Thank you so much for calling me. As a matter of fact, I'll handle the marketing. Y'all, I need you to preview that marketing before it goes out. Because when it goes out for that broker open, for that property, from that lender buddy, it's going to be, in addition to their name and face and contact information, it's also going to include yours. And even though you didn't make the flyer, aren't you out there promoting zero down payment, low down payment, number of payments if they've hit those trigger terms? So if your name's on it, you could be held liable. You could fall under violations of regulations. The question comes in who this comes from. It all starts at the top from the Dodd-Frank Act. It all comes down from Dodd-Frank. I don't know exactly where in the pecking order thread is, but it all comes from the top, from the feds. It's all part of that consumer protection. It's all about protecting the consumer. So y'all, do not take that gift card. It's not worth it. Watch your ads. Make sure, especially if you get into seller financing, make sure when you're advertising available seller financing, and then you say something like, contact me for more information. Don't get into too in depth because you run the risk of hitting those trigger terms. Questions on TRID, TILA, RESPA? We'll get a little bit more into it when we get into Unit 11, when we get to go to closing. 10 or 11, one of them. Another lender law for lenders is their Equal Credit Opportunity Act. And the Lenders Equal Credit Opportunity Act is, compare it to our federal fair housing. So we know under federal fair housing, our protected classes, lenders have to follow, they have to abide by federal fair housing because they're dealing with the people, the protected classes in the transaction. And in addition to federal fair housing and state fair housing, the lender also has their own set of protected classes. Some of the protected classes are the same in federal fair housing. So similarities: race, color, religion, and national origin are covered under the Equal Credit Opportunity in addition to federal fair housing and North Carolina fair housing. You'll note the lender doesn't have the protected class of familial status, because familial status is about our children. You got to be of 18-year-old to get a loan, right? So the lender's not dealing with the familial status. Sex is not a protected class under the Equal Credit Opportunity Act. So there are some differences. In addition to the lender's race, color, religion, and national origin, classes they have that we do not. Age, assuming the applicant is 18 years old. That's what that little asterisk means. Equal Credit Opportunity Act for the lenders, age is a protected class, assuming you're an adult, assuming you're 18 years old. In other words, if a 90-year-old walks into a bank and applies for a 30-year mortgage, I'll let you do that math. They can't be denied because of their age. They can't be told no. As long as their debt to income ratios shake out, as long as their qualifying ratios shake out, you cannot be denied a 30-year loan because you're 90. So age is a protected class. Marital status is a protected class under Equal Credit Opportunity, under the lender's protected classes. And then assistance with or reliance on public assistance. So if the applicant has some public assistance dependency, they can't be denied a loan because of that. Again, the debt to income ratio always has to shake out. The qualifying buyer ratios always have to shake out. But just know that we have some similarities between our protected classes, and we also have some differences. I would do, if I were you guys, I would do a nice side-by-side comparison. What does federal fair housing have that equal credit opportunity doesn't, and vice versa? Another lender law is the fair credit reporting. This is how credit's evaluated. So we all know that we have our fair credit reporting comes from 3 sources, TransUnion, Equifax, and Experian. You don't need to know that. We probably already know that though. And one thing that the Fair Credit Reporting Act does is it gives us, the consumers, the right to pull one report each year. One report from all 3, TransUnion, Equifax, and Experian. So by pulling that one report each year, we can keep an eye on our credit. Y'all, if you're not doing this, put a real estate aside for a second. If you're not doing this, please start. Once a year. I like to do mine in January. New year, new credit report. It's easy for me to remember. But guys, so many times people don't look at their credit reports for years and years and years. They don't tell you when something hits your credit report. Unfortunately, you don't know it until you look at it or you apply for a loan. And so many times we don't learn about issues on our credit report until we're trying to get a home loan or a car loan or something like that. So the recommendation is we pull it once a year. If you find an issue, then you can get it cleared up. There's instructions on there on what to do next, kind of thing. But that all falls under the lender laws as well. And then another big thing that lenders need to be aware of that you and I can also help greatly, and it's really big, and it's really bad, and it's mortgage fraud. Mortgage fraud is lying on your application to get money. Maybe you're fluffing your numbers, maybe you're not providing everything, lying by omission. Lenders are on the lookout for mortgage fraud. There are hefty and healthy penalties with mortgage fraud. You could be looking at fines up to 7 digits. You could be looking at time in the big house with the little windows. Mortgage fraud is really, really bad. So some examples where the lenders, and even you and I might come across it, could be the borrower reporting false assets or income, fluffing their numbers, saying they make a lot more or even a little bit more than what they actually do. This is a big job of underwriting, is to verify that information. That's that deep dive that they're doing. Applying for a false intent. Maybe you are applying for an FHA loan. We know on the FHA loan, it's got to be owner occupied. So on the loan application for an FHA loan, one of the questions is basically, are you going to live here or not? And if you say, oh yeah, I'm going to live here, and you have no intentions of living there, they've committed mortgage fraud. Straw buyers. This is when a less qualified buyer uses a better qualified buyer for their income. So maybe I don't have good income, but my buddy Bob does. So I say, hey, Bob, you got better credit, you got better scores, you got better income. Why don't you just go get me a loan? And for some reason, Bob agrees to do this. I would be a straw buyer. I'm using another to try to get that loan qualified under their name. Contract kiting, using a false contract. So we go under contract. We have the real deal contract. Buyer's agents, one of the first things you're going to do when we go under contract is get that contract to the lender. So we go under contract, signed, sealed, and delivered, and then the broker sends a different contract to the lender. That's called contract kiting. As you can imagine, that's not good. What all of this sums up to at the end of the day is all lies. You cannot lie on your mortgage application. The borrower cannot lie on their mortgage application. Yeah, and there it is. There's 7 digits and time in the big house with the little windows. As brokers, you and I are on the front line and we're hearing a lot of things. And I'm certainly not suggesting that you tattle or tell on people, but if you hear something, say something. It's not my job to yell mortgage fraud. But if I suspect something, I am responsible for letting the lender know so they can look into it. And a lot of times you and I might hear our buyers say something. Can you reside in multiple states under an FHA loan? So remember, you got to be owner occupied. So one of them has to be owner occupied. The other properties you could get a conventional loan for, but you can only live in one. And I think there's some rules there and how often you have to live there. So if it's like 6 months, then maybe you live 6 months here, 6 months there. Look into those rules. But really, that's the big thing is you got to be owner occupied, no investment properties. Last week, for example, mortgage fraud, we talked about the loan to value ratio, and the lender defines value as sales price or the appraised amount, whichever one is less. So let's say we go under contract and the property doesn't appraise for that amount. So we talked about what happens. Maybe we get renegotiate the purchase price with the seller. Maybe the buyer's got money laying around. They got some options. It's not over yet. But one thing that comes up is that the buyers will ask on the regular, can't I borrow the difference? I know my parents have the money. Can't I borrow the difference from my parents? Well, the answer to that question is going to have to be up to the lender. They decide if they can borrow that loan or not from mom and dad. But one thing that the lender might suggest or ask is if mom and dad can gift that money. Do we hear the difference in gifting money versus lending money? Lending implies it's got to be paid back. So mom and dad say, we'll gift the difference for you to buy your home. And then after closing, mom and dad say, now that you've bought, pay me back. Mom and dad probably signed something saying from the lender, going to make them sign something saying that this is a gift and they don't expect to be paid back. And if that's not the case, mom and dad have committed loan fraud, which is never, ever good. And that is all I have to say in the wonderful and wild world of financing. What questions do we have? Okay. Let's put pre-licensing aside for a minute. Let's take a bit of a break and a bit of a breather. And let's talk about a couple other things now that we are official midway-ish, midterm-ish as far as the material goes. Or the time, I guess. Anyway, we're midterm-ish. So we got a couple other things to talk about. First and foremost, you guys, after class today, will have your midterm available. So the midterm is going to start after class today. I've already set the email up. It is scheduled to go out at 2. So as soon as we log out today, you guys check your email and you will have a link to the midterm. The midterm is required that you attempt it. So if we go back to our day 1, our welcome PowerPoints here. And one thing that we learned on day 1 was what you need to do to get your certificate of completion for this class. So step 1, your certificate of completion, what do we need to do? Well, you need to meet the attendance requirements. We've talked about the 15 hours. You need to attempt the midterm, and then we need to pass the end of class exam. So I need everybody to see and acknowledge. I'm not looking for pass or fail on the midterm. All I'm looking for is that you try. Head bobs. This sends you guys stressing out when you make a 74.3% and you think you're kicked out of the class. Head bobs, everybody's hearing me. I need you to try. With that being said, I highly recommend you treat the midterm as if it were your exam. Treat the midterm as if it were your end of class exam or your state exam, which means when you're ready to take the midterm, you go to the email, you click on the link, and you sit down in a distraction-free area. Allot yourself about 2 hours. Maybe you'll need that long, maybe you won't, but allow yourself about 2 hours and treat it. Ask yourself going into it, if this were the end of class exam, would I pass? There is some math on the midterm. It's only on units 1 through 6. There's not a lot of math. The weight of the midterm is very reflective from your exam. So you're going to see a lot of questions from unit 2, a lot of questions from unit 3. There's 50 some or 60, I don't remember exactly how many, but allow yourself 2 hours. Most of the time we get it done within that. Maybe you take the whole time, maybe you don't. And again, we're treating this as if it were an actual exam. So I would recommend no notes, no books, no flashcards, because we know we can't have that on our exams. So I recommend treating it as much of your end of class exam as you can. The midterm is open until Monday night, Monday the 8th. So it's open until Monday night. I don't know exactly what time, but I told Jane to make it open as late in the day as she could. And I think it's 11 something PM, but I wouldn't, you got from today until Monday. So I would just plan on having it done before Monday night. When you're finished with the midterm, let me back up. When you start the midterm, you're going to put in your name and your email address. So when you're finished with the midterm, you're going to get emailed your results. You're not going to be able to see the specific questions because we're treating this like a real exam. And for your exam, your state exam, you can't see the specific questions. However, what you get in the email when you're finished is much more valuable than seeing those specific questions that you're never going to see again. And what you get at the end of the midterm is a breakdown of how well you did in unit 1. How well did you do in unit 2? How well did you do in unit 3? So you get the breakdown that allows you to see, gosh, I made it 80% in unit 2, but I only made a 60% in unit 3. Which unit should you spend more time on between now and your end of class exam? The one that you didn't pass. So the midterm, the results allow you to see your areas of weakness, where you need to improve, where you need to continue. So again, I got it scheduled. It's scheduled to go out at 2 o'clock today. For some reason you don't have it by 2:05, please reach out to me. Do not wait until Monday and say, Julie, I never got the email. Hopefully you all are getting my email. I know I've sent the Google Drive and the YouTube channel. I didn't have anybody tell me you didn't get it. So we all should get this one. If you don't, for whatever reason, please let me know today so I can make sure that you get it. I got a question. What do we have to make to pass the end of class exam? To pass the end of class exam, you have to make a 75%. Let's see. What time are we allowed to start the midterm? The moment you get the link. The email's coming out at 2. You can start at 2:01. You only get one shot at it. So be ready, be prepared, and do it in one setting. Because if you don't, it's going to time out and your shot is over. So as soon as you get the link this afternoon, you're welcome to start. You have till Monday. And I need everybody to try if you want to continue in this class. Questions about the midterm? I get your results too as well. So I'll be able to see, I'll be able to give you credit. And you'll get your results, I'll get your results. Of course, if you have questions about your results, if you want to talk about your results, I encourage you guys to reach out to me. We're just over 3 weeks. Oh no, we're just over 2 weeks, aren't we? It'll be 2 weeks on Thursday. Golly, tomorrow's October, y'all. How about that? What do we have to say about the midterm? What questions can I answer? The other thing I want to remind you about, we're getting to talk about your application process, but the midterm, we're getting ready for the end of class exam. That's in a little over 2 weeks. We're getting to talk about what happens when you pass my end of class exam. But I do just want to throw a couple reminders out. First off, that email you guys got from Lane that you use every single, class to access this call. Within that email from Lane, I want to remind you that there's a tutorial video on taking your exam, on accessing your end of class exam. And Jane walks you through that process step by step. So if you haven't watched the video, I really would like you guys to do so between now and our end of class exam, so you know what to expect. You know what you're going to get. We will talk about this in specifics when we get closer to the end, but this video is here. If you've watched it, it can't hurt to see it again. If you haven't, please do so. Again, Jane's done a very good job, very thorough, of walking you through step by step so you know what to expect. I know that's a concern. We don't know what to expect. So here it is. Additionally, in our Google Drive are supporting documents about your end of class exam. So you can either watch the video, you can look at the supporting documents, both. I don't care. But what we have in Lane's email and in Google Drive is all here to help prepare you guys, help get you ready for what to expect for our end of class exam. The last thing we do is go over specific rules and expectations. I like to do that at the end so it's fresh in your mind. So the last thing we'll do the last day is go over the rules and expectations, but you guys have the actual exam, what you need for the actual exam here. Remember Becky came on day one and said things like Chromebooks don't work, things like that. So all that can be refreshed. And if you have an issue, I'd rather you discover it now and reach out to Becky to work out before the test. So I encourage you to refresh and review the information for your end of class exam. Any questions whatsoever on the end of class exam? Understanding we'll get into the specifics in a few weeks. Remember also in Google Drive, we have our tentative schedule, which gives us some upcoming dates. We're at the midterm after we finish Unit 6. You got a cram course scheduled for October 17th with Anne. Lane will email you Anne's Zoom link on the 16th. So you have it at the top of your inbox. So you don't have to hunt for it. The cram course is optional, but it's recommended if you can come. No, Anne's not going to cover everything from 10 to 2. She can't do in 4 hours what's taken us however many classes, however many weeks. but she can't hit on the highlights. So as the name implies, she's going to try to cram as much in to help get you guys ready for your exam. Your end of class exam, the link opens at 9 a.m. on October 21st, and it goes the whole way through 9 p.m. on October 22nd. So you have 2 full days there, and you can plan on taking your end of class exam at any time during that window. I get asked a lot, are you telling me if I want to take it at 2 o'clock in the morning, I can't? Yes, within that window. And the reason we do this is because everybody's brain is better at different times of day. So plan accordingly. Are you fresher and more alert in the morning? Or are you a night owl? So plan your time accordingly. Distraction-free zone. No notes, no phones, no things like that. And then we have our dates for the retake. If you do not pass the end of class exam, and you make at least a 50%, you are eligible for the retake. Same thing the following week, the 28th through the 29th on those days. So the cram course, your final exam dates, and then your retake date if you need it. You get a free, well, it's not really free. You got to pay $14 for it, but you get a very cheap second chance. How many times can we say that in life? Anything on the end of class exam. So let's talk about what happens once you pass the end of class exam. And it's so important that we hear that this conversation is after the end of class exam. Please don't mix the two. So end of class exam, learn, test, pass with Becky. You got tutorial videos, handouts, things like that to help you see so you know what to expect. You passed Julie's class, and now the question is, yay, now what do I do? Retake is only for end of class. The retake is if you don't pass the first end of class exam and if you make a 50% or more. So it is like a second shot of that end of class exam. So you've passed. Congratulations, 75% or better, and you've passed. May that be the end of class exam or the retake. So now we need to go back to our real estate licensing in North Carolina booklet. We spent some time in here in Unit 1. And we said we're going to leave some of this for later. And now here we are for later. So there's testable materials in this booklet. And there's also the information that you need once you pass our end of class exam. The real estate licensing in North Carolina booklet can be found in our Google Drive. I do have the current one loaded for us in our Google Drive for you to pull, for you to rely on. And we're going to kind of skip ahead. There's a lot of this stuff, well, all this stuff we've already talked about in Unit 1. And we're going to make a note for me. We're skipping ahead to page, where am I? Page 8 of the booklet. Page 8 of the booklet gives you your application process, and understand this is a process. You've got to do it in order. Please don't try to skip around. You're not going to be able to bust the system. So we're going to do it in order. Step 1, you guys are currently in the throes of step 1. Step 1 is to pass the end of class exam through a pre-licensing course. Once you pass the end of class exam, then you're going to submit your application. I will show you in just 1 minute where you access your application. You'll have a portal, you'll have an account with a log on. I'm going to show you all of that in just 1 minute. So you pass the end of class exam. Lane sends you your certificate of completion. That certificate of completion is what you need to submit your completed license application. Once you submit the completed license application, then the real estate commission, this is the first time you hit the real estate commission's radar, is when they're reviewing your application. They don't know you exist until you submit that application. So you submitted your application, the real estate commission is going to review it. If it's incomplete, or if they have questions, if they have anything else that they need to get from you, they will be in contact. They will be in touch, and they will communicate with you through that account that I'm getting ready to show you where to access. Assuming there's no issues, further information, the real estate commission will approve your application, and upon approval, they're going to send you a notice of exam eligibility. And your notice of exam eligibility is the golden ticket you need to apply to the testing center. The testing center doesn't know you exist until the commission issues you your notice of exam eligibility. And I'm going to be really honest. This is where Lane and I get the most calls. You guys call us and say, I've submitted my application. I contacted the testing center and they said they don't have me in their records. And Lane and I usually say, did you get your notice of exam eligibility? Well, no. Well, then they're not going to have you in their records. So you submit your application, and then unfortunately, you wait and study, preparing for that state exam. So your notice of exam eligibility, once you get that, that's your golden ticket. Now you contact the testing center. I will show you how to do that in just a second. You contact the testing center to schedule your state exam. They're not doing it online. It's all in a testing center. Again, more on that. Please bear with me. Once you go to the testing center, you take both sections, national and state, at the same time. When you pass, they will mail you a license. If you don't pass, if you fail, we'll come back to that. If you fail one or both sections, you have to reschedule to retake the section or sections that you fail. So the first time you go, you're taking both national and state. If you fail one and pass the other, let's say you pass national and fail the state section, you have to go back and take the state section only. If you fail both, you have to retake both. And you got to keep going until you pass both sections. They're going to do a character review on that. We're getting ready to pull a background check. We'll see that in just a second. They're going to do a character review before they issue your license. The fees, if you're taking both sections, the examination fee plus the application fee. So if you're taking both sections, it's $160 every time you walk in the door of the testing center. If you're just taking one section, you pass the national and fail the state. If you're just taking one section, it's $150 every time you walk in the door. I highly recommend you guys not submit your application until you're ready. You and I end 2 weeks from Tuesday or Thursday. I mean, you and I end soon. But when we're done, you've got to keep going. And some of you are ready to do it right now. And as soon as you're done, go for it. Others of you are not, and you want more time. I recommend you not submit your application until you're ready to go, because we're going to see in just a minute, your notice of exam eligibility is only good for 6 months. So you have 6 months to pass both sections. And when that 6 months is over, it's over, in which case you would need to start here again. You would need to resubmit your application, resubmit your background check. So many times you guys call me and you say, like, for example, it's October. Let's just pretend it's October. And you call me and you say, I submitted my application. I said, that's awesome. You say, but I don't think I'm going to go till January or February. You just wasted October, November, December. You just wasted half of your time. Does everybody see what I'm saying? As soon as you get that notice, as soon as you submit, you're starting that process, that 6-month clock starts. So if you're not ready to go till January, don't submit your application until December. I want you guys to have as much of that 6 months as you need. Yes. Yes, and and I'll come back to that because that's the end of class exam. So I just want to stay on this right now. So I'll get that in just a second. Okay, so the application process, page 8, please highlight that page because this is the step-by-step. What else do we need to know? Here's your time frame for obtaining a license. It just talks about the application process, what you can expect. Make a note here that they kind of walk you through the online application system. So if you're stuck on anything, you have a reference point here. You can also always reach out to Lane. I tell you, I'll be honest, Lane is really good at helping you guys troubleshoot through your application system. But where Lane's getting her information is from right here. So it kind of walks you through step by step what you expect. Again, I'll show you where in just a second. Part of your application is to apply for a background check. You will be required to submit a background check from the Real Estate Commission's company that you find in the application process. Please do not submit another background check. The Real Estate Commission will only look for theirs. And it's all in the application process that they will walk you through step by step how to order it. The background check should go back, I've heard 7 years. You're going to be asked on your application about any previous criminal offenses. I recommend you list them all, even if they're older than 7 years. It may not show up on your background check, but it's still recommended that any blemish you have in your past, go ahead and fess up to it. And listen, just because you may have a blemish in the past does not mean you're not going to get a license. The Real Estate Commission reviews all applicants on a case-by-case basis. Have you served your time? Have you paid your debt to society? Are you moving forward? And if so, you still might get a license. It's not an automatic out if you don't have that, crystal clear past. Question comes in that 6 months, can I try as many times as I need to? Yes. Yes, they make you wait 10 days in between, but you could go day 1, day 11, day 22. You could go as many times as you need to within that 6 months. So again, just instructions, what they're looking for, full legal name, make sure it matches your driver's license, criminal background check, showing you that in just a second. Here's what they're looking for with your character and any criminal record. We talked on the first day actually about doing a predetermination, a petition to see if based on your criminal record alone, you could get a license. So if this is concerning to you, make a note. We are on page 12 of the book. You can look more into this, contact the Real Estate Commission. Please don't call Lane and I and tell us what you did. That's not a decision for me to make. Address that directly with the Real Estate Commission. If you've only lived in North Carolina for the last 7 years, you'll probably get your background check back pretty quickly and the cost will be minimal. I don't know the cost. If you've lived in other states or other countries for the last 7 years, it's going to take more time and it's going to cost more money. I don't know specific to each state how much and how long. I don't know specific to each country. That's something you'll come across with your own application. But I love it. They call out New York. If you've lived in New York State for the last 6 or 7 years, call it out. Say this might take a little longer. It might cost more. So if you have outside of North Carolina in your past 7 years, it just is going to take longer. So we need to take that into consideration. Again, it's all in your application process. They even tell you what is considered a character issue, who would raise a flag. So again, if this is concerning to you, please look at this. And there's that petition for predetermination with links and websites that can help get you in the right direction. Okay, the exam. So this is a broker exam. The testing center is Pearson View. We have multiple locations all over the state. As we said, it's a national section and a state section. When you go the first time, you'll be taking both sections. You can't pick and choose. You can't take one later and come back and take another one. When you go, if you have to take both, you take both at the same time. This is breaking down the retake. So if you don't pass both sections, when you go back, it's $160. Anytime you take 2 sections, it's $160. If you're just taking 1 section, then it's $150. And guys, please hear me. This is every time you walk in the door. I had a pre-licensing student last year. She broke my heart. I don't know why we do what we do. But the weekend before her state exam, my girl went to Vegas. I would have recommended she stayed at home and studied instead. But anyway, she went to Vegas and she packed her Vegas purse, her party purse. And when she came home, she forgot to switch from her party purse to her daily purse. And she showed up at the testing center without an ID. And they said, if you can't prove who you are, we can't let you test. Y'all, did she walk in the door? It cost her $160. She had to pay that again once she got her ID. She's given me permission to share her story so we all realize if you're not ready, for whatever reason, it costs you $160, which is another reason why I'm saying, please don't go until you're ready. I'm trying to save your wallets here. Please don't go until you're ready. Examination format, this is a good, they kind of give you some samples and hey, what about some practice test questions here as well? Make me a note. On page 17, I get asked a lot, how do I know what I'm going to be tested on? Ta-da! You're going to see 11 questions from real property. You're going to see 16 questions on the national for contracts and agency. You're going to see 7 on financing. There's your 7 math questions, and then it gives you the same breakdown of the state section. So it tells you the topics. It helps you identify those testable areas. The topics, the categories are as they relate to the syllabus. So if you want to know more about what's covered, what are the 11 items under real property, then grab your syllabus and see what the syllabus has to say about real property ownership, valuation, etc. By the way, let me say this too. The 11 questions on real property, for example, there's thousands of questions in the test bank, thousands of questions in the test bank. And every time a new candidate sits down to take a test, the system randomly generates an exam. So of those thousands of questions on real property, it's only going to pull 11 questions. I don't know specifically what 7 math questions you're going to see. What I do know is you're going to see 7 questions on the math. Maybe you see qualifying a buyer, maybe you don't. Maybe you see commission, maybe you don't. It's a randomly generated, and what that hopefully does is prevent cheating. That stops me from taking the test and then running out in the parking lot and telling you what to expect. You know you're going to get a bunch of questions on agency. I just can't tell you exactly or specifically which questions, which is why we're covering all of the material to prepare you for those 7 questions on financing. Cheating's a big deal with the state exam. All right. I got more to say, but we also got to take a break. So let's take 10. We come back, we'll wrap up this conversation about our application. We'll see where you go. back. And I promise at the end, once we get through everything, I open it up for questions. But I might be getting to some of your questions right now, so just bear with me. The cameras are on. I am going to take attendance. Emily, you're in. Okay, so the application process, we looked at the weight. The number of questions for the end of class exam may not be exactly like these, but the weight's going to be the same. So again, this is specific for your state exam. But I mean, my job is to prepare you for the state exam. And part of that preparation is getting us through the end of class exam. So it really does try to be as reflective as the state exam as it can to help better prepare you guys. So the weight, you can expect the weight of the material to be about the same. As we just saw, your national section, you have 80 questions. Your state section, you have 65 or 60 score questions. Actually, on the national section, you're going to see 85, and on the state, you're going to see 65. Because what they give you is 5 pre-test questions. I call them test the test questions. You can expect 5 questions that will not count for you. They will not count against you. They are simply vetting those test questions to throw into the pool. So they're constantly coming up with new questions as the material changes, as laws and rule change. They're constantly creating new questions. And before they officially put them on the state exam or your state exam, they're going to run them through you guys, let them vet it to make sure they're good questions. The questions that do count, previous candidates have done that for you guys. So that's just part of the process. You'll never know the pre-test questions. That's just for them. To pass, you have to make a 75 on both sections. Both sections are 75%. Our end of class exam is 1 score of 75%. So if the 2 average out, you make a 75%, you're in. For the state exam, you've got to score 75 on each section, the national and the state. And by the way, all throughout the RELINC book, there's these blue links. They got video tutorials, that kind of thing. So it's here to help you guys get through the process. You got that notice of exam eligibility from the Real Estate Commission. And like I said, this is your golden ticket to get into Pearson VUE Testing Center. You will be provided with instructions on how to contact Pearson VUE once you get your notice of exam eligibility. So once you get that, you'll be able to either go online and schedule or call them and schedule. They'll give you the different options. Talking again about the 180 days that your notice of exam eligibility is good. You got to pass both sections within that 180 days. Here's contacting them. It's all in here as well, and you'll get instructions in an email. So it's all here. Let's see. They even check it, y'all. They even give you screenshots and step-by-step for scheduling online. So once you get that notice of exam eligibility, you can come back to your RELINC book. So screenshots, here's the centers. Doesn't really matter where you are in the state of North Carolina, there's a good chance that a testing center is near you. The P's, the little blue P's there, or white P's in the blue, those are Pearson VUE's actual centers. The yellow flags are partner locations. So maybe like a community college, for example, they might allow testing there. And then the little flags are a military location. If you're military, then you can test on your campus. You have to have military access to get to these testing centers, though. So if you don't, then you're just with the either Pearson VUE or the little flags. But this is a pretty good sample of the state. Again, no matter where you are, there's a good chance that, you know, something's nearby, something's close. So you can pick the center closest to you and schedule at that time to go. Or call them, either one. When you schedule your state exam, I would take a minute to, let's see, I'm on page 25 of the RELINC book. And I would take a minute to review Pearson VUE's test center policies, make sure you're in compliance. Again, it walks you through about what you can and cannot have with you while you're taking your exam. Understand Pearson VUE Test Center is a testing center. So it's not just real estate candidates that are there. They're also got CPAs and CNAs and cosmetology and, anybody that has to take some kind of licensing exam. So they have so many seats available for real estate. And real estate tells Pearson VUE, the Real Estate Commission says, this is how we want our test handled. So the testing center policies, make sure we're in compliance. We're doing what we are not supposed to. If you need to reschedule, so if you don't pass both sections the first time, then instructions here on rescheduling. Pearson VUE Testing Center will work with candidates with disabilities. So if you have any learning disabilities, on page 26, and you will need to reach out to Pearson VUE to accommodate that disability before you show up on that test day. So this walks through the process of what you need to do, how you can get those special accommodations. Again, please don't wait. Don't show up on test day and say, I have a learning disability. They need to hear from you ahead of time so they can make those special accommodations. What happens when you get there? Everything to expect, you guys. It's all right here. What IDs do you need? What will they accept as a primary identification? What you have to take with you. Don't be like my girl that didn't show up without a driver's license. That's a costly mistake right there. So what is and is not allowed to prove your identity. Timing. Each section is timed separately. So you get 2.5 hours for the national section, you get 2 hours for the state section. Once you start a section, the clock does not stop. So once you start the national, the clock's going to keep ticking for 2.5 hours. As far as breaks go, I think you guys should take a break. And I encourage you to take the break in between the national section and the state section because your clock's not going. So when you're done with the national, you'll have to start the state. And the recommendation is that you take the break in between the two, because if you start the national and an hour into it, you need the restroom, your clock keeps ticking. So go fast, but you know that you can and are encouraged to take the break in between. Even if you don't have to go, gosh, get up, move, stretch, roll your neck around, get some few deep breaths in to prepare you for that state exam. So you've passed. Yay. Pearson VUE does not give you a real estate license. The North Carolina Real Estate Commission gives you the real estate license. So Pearson VUE might say congratulations and then send you on your way. The Real Estate Commission, once they put their finishing touches on everything, the Real Estate Commission will mail you your license after the exam, after they finish everything. So that's when you get your license with your license number. You're not going to walk out of Pearson VUE Testing Center with that information. Excused absences, inclement weather, all that good stuff. Let me make sure there's nothing else I need to say here. And then we're back to what we talked about in Unit 1, actually. So Unit 1 bookmarks, the RELINC book, the stuff in the middle is the application process. Okay. So that's the RELINC book. So where do we start? It all starts at the Real Estate Commission's homepage, which is ncrec.gov. Or if you don't remember this, you can Google North Carolina Real Estate Commission and it'll come up. So it all starts with ncrec.gov. Once you guys get licensed, by the way, this website is a plethora of information, helping to educate the consumer. And since we're working with the consumer, the Real Estate Commission says, hey, if you find something on our website that you can use and working with the public, by all means, feel free, help yourself. So we're all working together to help educate the consumer, help protect the public. So just FYI, once you get licensed, you may want to start poking around. Publications is a good one. Resources, obviously. Here's a whole tab on fair housing. So as you're gathering all that data, use the real estate commission site as a good source for you as well. Tuck that in the back of your brain for now. For your application, ncrec.gov, I'm on the home page and I'm going to scroll down, not quite to the bottom, but almost to the bottom. And I'm going to get to a big button that says apply here for a license. And guys, this is where it all starts. Whether you are ready to submit your application when we're done in a couple weeks, or if you want to wait, there's no reason why all of you can't start now. Clicking on the button, creating your account, and if nothing else, starting to see what it is that they're going to look for. I know, for example, they want your addresses where you've lived for the last 7 years. So if you've moved around a lot in the last 7 years, you can start gathering that information now. Your background check can be ordered, is ordered through this link as well. So everything you need for the applying the license, creating your account, communicating with the commission, coming back later and submitting it later, everything you need all starts here, ncrec.gov. Apply for a license. By the way, your background check is also only good for 6 months. So if you order it today and it comes back next week, you're going to start eating that time. So depending on if you're one state or multiple states, multiple addresses, some of you may want to wait a week or two to order your background check. Some of you may want to wait until you pass the end of class exam. But just know it's only good for 6 months, as well as your notice of exam eligibility. What questions do I have about your state exam only? We'll come back to the end of class exam. Let's just focus on that state exam. If you start your application now, you can only get so far until you get the certificate of completion from Lane. So you can't submit it until you get that certificate of completion. That document from Lane that she'll send you when you pass has the school code on it, and it has my instructor code. And those are 2 pieces that are part of your exam that you're not going to get. So again, you can only do so much, but some of you are ready to go. And if that's you, as soon as you get that certificate of completion from Lane, you can plug in those 2 codes and you'll be ready to hit submit my application. Some of you may want to wait, not even touch it until you pass the end of class exam. You all know your time frame. You all know your goals and your agenda. So this allows you to work with you and your goals and what your agenda. We have 2 chances with the state. As a matter of fact, you can go back to that state exam as many times as you need to within that 180 days. They just make you wait 10 days in between. They call it a cooling off period, which is a good opportunity because you'll get a report from them as well that tells you where your areas of weakness are. So it gives you a good opportunity to refresh and review. But yeah, you go to the state exam as many times as you need to within that 6 months. Just know every time you walk in the front door, it's either $150 or $160. 2 sections is 60, 1 is 50. Can you see the exact questions you missed? No, not on the state exam, not on our end of class exam. Those test questions are protected because we don't want you sharing those test questions with other candidates. What you do get, similar to the midterm, you're not going to see the questions you missed. What you are going to get is a report that gives you the breakdown, what percentage you made in this section, what percentage you made in that section. And honestly, you guys, I think that report is much more valuable than actually seeing the question, because you probably won't see that question again. So what we need to get you to improve your score on is contracts or agency or whatever, wherever that area of weakness is. So everybody's good that there are two tests that stand between you and your license. You have mine in a couple weeks. Once you complete mine, then you go on to take test number 2. Let's see. What is the procedure? Okay, so now we're back. So no more state exam. Now we're going to get back to the end of class exam. Before I got that, I had another question on the end of class exam. So let me take these in order. Again, we're backing up and we're just focusing on the end of class exam. The first question I got is, are we taking the final exam at home? Yes, on your own time, on your own dime. So at those 2-hour window, wherever it's open, if you can't find a distraction-free place at home, then call a friend or a family member, go to the library, find somewhere where you can be distraction-free. But all you need is internet access to take your exam on your time. The other question I got for our end of class exam is how I proctor. And this is what you're going to learn in the video from Jane. This is what you're going to learn in the handouts. Your end of class exam is proctored by AI, but it's reviewed by a human. So if AI picks up on something, they're going to flag it. And then Becky with Learn Test Pass is going to review it. For example, they told us a couple years ago, there was a lady taking her state exam and the 3-year-old ran into the room. You know, the uncontrolled 3-year-old ran into the room. Mommy, mommy. Well, the kid talking picked up on AI. AI picked up somebody talking. And when the human went back and reviewed it, they said, well, I'm pretty sure a 3-year-old is not giving answers for the end of class exam. So AI detects movement, sound, things like that. The human reviews it. Your end of class exam, it's so important you guys hear me say this. The authors for your end of class exam are the same authors that wrote your practice questions for Learn Test Pass. So the best way I know to prepare you for your end of class exam is by taking those Learn Test Pass quizzes. That gets you familiar with how they're going to ask the questions. So please, if you're not utilizing Learn Test Pass, this is a great time to start. For the 50% for the retake, so we're back to be eligible for the retake. So let me answer it this way. The end of class exam and the retake is 1 score. It's 2 sections with 1 score. They average them together. So you have to pass 75% combined both sections. When you get the state exam, it's 2 separate sections that you're scored on. You got to pass both sections. With mine, you just have to have an average of the 2. And there's weight involved. It's not simple averaging. 1 score for the end of class exam, 2 for the state exam. What else? And again, as you get going on that application process, sometimes they don't accept it because Lane's got to submit you as well from her end. It's a 2-fold system. And so the application may not get accepted, and it may tell you why, like the dates don't match or your name. You know, if you're not submitting what's on your driver's license, and if Lane doesn't know what's on your driver's license, If the name doesn't match, then they may send it back. I say all that to say Lane's really good about troubleshooting with you guys. So if your application comes back, if they say the information doesn't match, please just reach out to Lane. By the way, if the name you registered with isn't the name on your driver's license, please reach out to Lane between now and the end of class so she can get that updated so all that matches. Either exam. Let's just open it up. Either exam. I know how this works. We're going to log out later today. We're going to think of something, or we're going to start the application process and a question's coming up. So you guys, please always remember that Lane and I are always here to help. Even when you and I are done on, what is our last day of class? Hang on. You and I are done on the 16th. So even though you and I are done with class on the 16th, y'all, please understand, you've got to keep going. You've got to keep studying. So hopefully we're forming these good study habits. Hopefully we're setting aside time to study, because when we finish, you have to keep going until you get that license. Please do not put the book down. We finish on the 16th. Please don't put the book down until the first of the year and not touch it for 3 months. Y'all know what's going to happen to that information if you don't touch it for 3 months? It goes somewhere. I don't know exactly where it goes, but it goes somewhere. So I need you guys to stay committed. I need you guys to keep studying until you're ready to go. The certificate of completion you get from Lane when you finish the class, the certificate of completion is good for 3 years. So if you have to reapply for a notice of exam eligibility, that's the 6-month piece. If you go over 6 months, you got to reapply for that notice of exam eligibility. If you go over 3 years, you got to take pre-licensing again. Please don't wait 3 years. You guys are always going to be tested on the current, and law changes, rule changes. So if you wait 3 years, a lot has changed. Anything else? And Lane and I are always here to help at any step in the process. In class, after class, up until y'all send Lane and I got an email yesterday from a former one of you. So today, Julie, today I passed both sections. I have my real estate license, and we celebrate together. And then we send you out in wild, the wonderful wild world of real estate. We're good? Enough for now? Let's Kahoot. Y'all grab your phones. It's just a quick, I think it's only like 5 or 6 questions. So this Kahoot, little bit from unit 4, little bit from unit 6. No math. I don't put math in Kahoot. That just seems mean. So just a couple questions. Remember, we're always looking ahead at where we're going, refreshing where we've been. I'm trying to get you QR code. It's thinking. Should think faster. Here is your QR code for this Kahoot. If you're going on the website of the app, you need a game pen. Again, this is a couple questions from Unit 4, a couple questions from Unit 6, just to kind of officially wrap up this section so we can move on. Onward we go. Another moment or so to get in. If you want to play, I'll never make you Kahoot. But if you're not playing on your phone, I just ask that you play in your mind. Use this to help us make sure we understand this material. It looks like some of your phones just went to sleep, so you may want to wake those up. Everybody in that wants to play? Let's see what we got. Units 4 and 6. Question number 1. Which of the following is not a protected class under federal fair housing? Ten seconds. Fresh corn helps us remember. Good job, you guys. Fresh corn helps us remember the protected class, familial status, race. The E in fresh is equal rights for all. Sex, handicap, color, orientation. I'm sorry, equal opportunity for all. The second R is religion. And then we also had national origin. So fresh corn spells it out. Occupation is not a protected class, which means you could discriminate against somebody based on their job, only based off of their job. I wouldn't recommend it, but we're saying that you could. Religion is a protected class, and sexual orientation and gender identity are now protected classes as of 2022 under sex. So sexual orientation and gender identity are now considered protected classes. Questions on this one? Let's see who got it right the fastest. Out the gate, I got, hey, you have to tell me who you are. I love that. Emily and Raj, Amber and Lauren. Question number 2. It is illegal for a lender to refuse to make a loan in a particular area based on the Five seconds. It is illegal for a lender to refuse to make a loan in a particular area based on the neighborhood, based on the area. The practice is called redlining. And the lenders can't engage in that practice. And what that practice was they put a map of the city up on the wall, the area of the city, whatever, and they'd literally take their red marker, walk up to the map and say, we're not going to originate any loans here. They're eliminating the loans. They're basically denying the loans just based on the neighborhood, based on the area on a map. And that's called redlining, and it's not allowed. Bottom line, it should come down to the applicant's debt to income ratio. And we talked about FHA and VA loans also have to meet property conditions. So certain loan types are twofold, but that's the specific property, not the area, not the neighborhood. Questions on this one? Now that I'm looking at it, I could totally see the blue one as well. So don't totally count yours. I could totally see the blue one. I would argue that myself. You guys are vetting these questions for me. These Kahoot questions have never been seen before. So I would totally give you credit for that now that I'm looking at it. I need to make a note to do better on that one. All right, let's see what we got here. Hey, staying on top. MJ, Marquita, Houston, and Courtney are on the boards. Welcome. Question number 3, the right a borrower has to regain their property ownership by paying the debt after the foreclosure sale is called. A second. You're redeeming yourself. You're saving yourself from foreclosure. States are different. Lien theory states does the equitable redemption, which means you can save yourself before the foreclosure sale. Title theory states does statutory redemption, which is after the foreclosure sale, in which case the borrower has a 10-day upset period. They can upset the bid. Either way, if you're redeeming yourself, you are saving yourself from foreclosure, and all states offer the borrower that right. Acceleration is a clause that's often found in the note, the promissory note or the mortgage note. And what that does is it accelerates the amount due when payments are missed. So in default, it accelerates the whole note due. If not, we're going to head to foreclosure. An assumption, the buyer could assume, take on the seller's loan, a loan assumption, take on that responsibility and the debt. And then hypothecation, that's the act of pledging the property to the lender. Title theory states the lender has legal title. The borrower has equitable title. The borrower pledges the property to the lender in the event of their default. Questions? Hey, staying up top, Houston came up. Marquita, MJ, and Courtney are the same, still on the board, just shuffled around. Shirley is our highest climber, up 11 places. Question number 4, the loan to value ratio is the seconds. Okay, let's talk about this. The loan to value ratio is through the eyes of the lender. So when you march into a bank and you look at the lender and you say, give me money, one of the first things that the lender is going to do is determine what that means for them. And they're going to look at, compared to how much the property is, the question to them, for them, is going to be, what do they want from me? What's the percentage of the loan amount that they want from me? And the answer to that is the loan to value ratio. And that is what we're asking the lender for. So if it's properties valued at 100,000 and I'm asking for 80,000 in loan, the lender's loan to value ratio is 80%, which means I'm putting down 20. Percentage of the borrower's debt to income, that gets us back to our qualifying ratios. Those qualifying ratios show us, of all the debt you have and all the income you have, are you going to qualify? Questions on this one? Questions on the loan to value ratio? See how that shuffled things up. Let's see. Hey, staying, actually, everybody's staying exactly where they are. All right, last one. Which loan product does the interest rate remain the same for the life of the loan? Ten seconds. Which loan product does the interest rate remain the same forever? Good job, you guys. That's that amortized loan. The amortized loan is our fixed rate. Remember, in mortgage speak, when we say rate, we're referring to that interest rate. So the adjustable rate mortgage, the ARM, tells us that that interest rate fluctuates. The graduated payment, we know the interest goes up. The interest rate goes up at predetermined periods of time. And then the blanket loan could have adjustable interest rates as well. It's the one that combines multiple parcels of land. So think about the developer that's going to buy 3 pieces of land to subdivide them and build homes. They may use a blanket loan and that interest rate might adjust. The amortized loan is our fixed rate loan, which means the interest rate stays the same for the life of the loan. Those are those amortization schedule that we looked at where we had the 3 steps and our principal and interest was the same every month. The only thing that changes is what's applied to principal, what's applied to interest. Questions on this one? All right. The podium. Third place Cahooter is Houston. Our second place is Marquita. And my first place Cahooter this round is, hey, that's fun to say. Tell me who you are. I'm dying. Let's see. I got MJ and T that were my 4th and 5th runners up. And everybody. Good job. Good Kahoot. Questions? Remember, you guys, Kahoot is not testable. I don't have the character. I have a character limit in Kahoot, so there's only so long I can make the questions. But hopefully the Kahoots give us an idea. If you didn't remember what a blanket mortgage was, that may be something you want to go back and refresh. If you didn't remember the protected classes, then that might be something you want to go back and refresh, for example. So the Kahoot's helpful. It gives us an idea. With that being said, I'm the fan of the Learn, Test, Pass quizzes. Speaking of Learn Test Pass, some of you have been diligently working through Learn Test Pass, keeping up with the units as we go. Some of you may not have started yet, in which case I really do hope we start soon. Time's a ticking. Sometimes, for those of you that have been keeping up with it, if you've been through the book and you've been through Learn Test Pass, you've been using the materials that you've already paid for. A common question I get is, what else can I use to study? And I do have some recommendations. Y'all please don't go to Google looking for study material because I can't verify that material. But what I can do is give you some recommendations if you're looking for additional study material. Exam Smart is an exam prep testing center. They have practice questions that you've probably never seen before with the explanations. They have video tutorials. There is a fee for this. I do not know how much. But Lane and I have vetted this. We're familiar with the Exam Smart people. And this is one that we definitely would recommend. Again, if you haven't done Learn Test Pass, please don't whip your wallet out to try to spend more money. Spend the time on what you already have. Does that make sense? All the money in the world doesn't prepare you for the exam. So utilize your wallet, your finances. This is just for those of you that are looking for more. And there are others out there. So if Exam Smart doesn't work for you, please reach out to Lane and I. We can offer other recommendations. Please don't go to Google. I don't know what you're going to find when you go to Google. The other program I wanted to share with you guys, this is designed to help you pass the state exam. So there's a North Carolina brokerexam.com, and it's a cram course for your state exam. So once you've passed the end of class exam, now you're preparing for your state exam. And this could be something for you to look into. Yes, there's a cost. I don't know how much, but this is a great platform to help you guys get ready for that state exam, put it all together. Kim Stotesbury is the one that leads it. Kim's a big name in the state. Kim does a lot with the state, and Kim does an excellent state exam prep class. And that's what we have at ncbrokerexam.com. Again, this is once you get out of this class. This is future you. You may want to look into it, consider it. I also know once you sign up at Pearson VUE, once you start that process, they'll offer to sell you some practice quizzes as well to help prepare you for the state exam. You may want to look into buying those just to be exposed to that author, the author of your state exam. That'll come from Pearson VUE once you get that notice of exam eligibility. So read the stuff you guys get. There's a lot of helpful stuff in there from Pearson VUE. What do we think? The practice test from Pearson VUE, do they give you feedback? I don't know. I don't know what those look like. But it's practice. So it might give you some more information. Unfortunately, once y'all leave this class, I guess I'm out of touch of the process. I got my license in 08, and I can tell you exactly what I did in 08, but I can also tell you it's not the same today. So basically what I know is what's in that RELINC book, which is a lot. It's a lot of information. I mean, y'all, here we go. When I submitted my application in 2008, it wasn't even online yet. I was still mailing in a paper copy. What? So as soon as y'all click on that button, apply for a license, you've gone further than I've ever seen. Anything else? Take a break, refresh, catch your breath. We come back, we're going to start into the wild world of appraisals. So we're going to get into Unit 7 in 10. And we are back. So, welcome back. I am going to take attendance. And we got another, it's called another non-broker. Well, mostly non-broker. We're going to talk a little bit about the broker in this section, but the star of this show is the appraiser. So we're going to talk about the appraiser's valuation process, how they determine value, what that term value means, and the several different approaches that the appraiser takes to arrive at value. We're also going to talk about where you and I fall into this understanding that we're not appraisers. Again, appraisers go take a class, they got to pass a test, they have to go to a state exam. It's a similar process. They have to apprentice so many appraisals before they're allowed to go out and do one on their own. So it's another licensing process, and it's another very important part of what you and I do to have this basic understanding of the loan process. So first thing we're going to do is define value and talk about some concepts and terms that revolve around value. And then we're going to look at some of the things that the appraiser looks at. So some economic principles of value, the various factors that affect value, and how the appraiser uses that information. The appraiser does the appraisal. What you and I do is a BPO and a CMA. So we're going to define all that, talk about what the difference is. And then the broker piece of it is to talk about the license law and commission rule that relate to the BPOs and the CMAs that you and I do. So first off, let's just start with and define what an appraisal is. An appraisal is one person's opinion on value. An appraisal, did you hear what I just said? An appraisal is somebody's opinion based on their market study, based on their research. The appraiser offers their opinion. What do they think the home is worth? So now, knowing what we know so far, could you have two different appraisers with two different opinions? Could you have different appraisals? Absolutely. Absolutely. All it is one person's opinion. That's why they go through the school and the training and the state exam. That's why they have to apprentice so many before they can go out and do their own, offer their own opinion. You and I are not doing appraisals unless you're a licensed appraiser. Is anybody a licensed appraiser? See any hands? So you and I are not doing appraisals. That's the appraiser's job. You and I are doing these BPOs and CMAs that we'll talk about. Appraisals are required for all loans. So anytime the borrower is getting a loan, the lender requires the appraisal. The appraisal tells the lender the value in the loan to value ratio. And the lender defines the value as the sales price or the appraised amount, whichever one is less. So the appraisal is the lender's opportunity for a second opinion. They require it. They know what a buyer's under contract to buy it for. But before they release that money, they want that second opinion. They want that appraiser to step in and say, this is what I think the home is worth. So now we have the sales price, we have the appraisal, and based off that information, the lender will issue the loan on the lesser of the two. If it's a cash buyer, appraisals are not required. But if the cash buyer starts asking a bunch of questions about value, then we're going to recommend that they have an appraisal done. It's only required for the lender. The lender will be the first to tell you that the appraisal is their property. It belongs to me. You do it for me. The lender requires it, but they let the buyer pay for it. It's part of their closing process. The appraisal report is for one specific property. The appraiser is offering their opinion only for 123 Main Street. They're going to look at the neighborhood. They're going to look at the surrounding area. We're going to learn all of that helps them arrive at value. But the report itself is only for one specific property. And it's only of a specific day. Values change, markets change, prices change. So values are also fluctuated. And technically, the only thing we know about this appraisal is as of this day, this is what they think the value is. Now, most lenders will let you use the appraisal report for up to 6 months. After 6 months, they're going to say the market has changed enough that this opinion on this one day doesn't really mean anything anymore. So we moved on. So it's for a specific day, but most lenders will allow an appraisal report for 6 months. So there's several different ways that we can arrive at values. And let's break these down. You know, back in Unit 2, we talked about coming to value for tax purposes. When we were listening for the assessed value for tax purposes. That's also done by an appraiser, but it's a different process than the appraisal process for one specific property. For the tax assessed value, they're going to look at a whole city or a quadrant of a city if it's a big city. They're going to look at the big picture for the tax assessed value. The appraisal is just for one property, and it's for the lender to determine their loan to value ratio, what that value is in the loan to value ratio. What you and I are doing are CMAs and BPOs. We will talk about these. Today, they're pretty much used interchangeably. So that's why we throw them out there. So we're going to talk about the difference in us and the appraiser, what you and I can't do, what the appraiser does do. Stay in your lane. And then another valuation method that pops up is something called an AVM, or an automated valuation method. You guys know these better as Zestimates. Have you ever been online looking for a home for sale? Something pops up and says, we think this is what the home is worth. AVMs, Zestimates, those kind of things. It's a different process. They're not as accurate as the appraisal or the CMA. They're not as accurate. They should not be relied on. I'll tell you at the end, once we have a better understanding of how these others work, we're going to be able to see that these are not the best methods for determining value, as they don't look at a specific property. They look at a whole area. So this section, this unit, is focusing on the appraiser's job of providing the appraisal. And then you and I are going to talk about our piece of the CMA or the BPOs. So let's talk about value. Can we all agree? We've all heard the statement that value is in the eyes of the beholder. Have we heard that before? Value is in the eyes of the beholder. So I want to share with you one of my favorite comic strips in real estate that illustrates value through the eyes of the beholder. I love the tax assessor. Cha-ching. So, through the eyes of the beholder, the home could be viewed differently. And that's why the lender wants a second opinion. That's why the lender just doesn't want to issue the loan on what buyer and seller negotiate. They want the second opinion of the appraiser. They got to make sure their money is going to good use. So they require that appraiser, so they have that second opinion so they can best protect themselves. Please understand, always remember, you guys, the seller, other than the tax assessor, the seller probably has more value in the property than anybody else, because to the seller, this is presumably their home. Blood, sweat, and tears went into this, memories, family time, good and bad. There's emotions involved with home. To everybody else in the world, it's just a house. It's four walls. So coming into this, understanding that the seller sees it differently than the rest of it, because it's their home. It's what we call it. So it's all about that eyes of the beholder. And when we look at various terms, get an understanding of some of the terms, we can look at market price compared to market value. Market value is what the appraiser is predicting. The appraiser's saying, based on my studies, I predict that the market value of this home is X amount. I predict that somebody would be willing to pay X amount for this house. Compare that to market price. Market price is what a buyer was actually willing to pay. Value is the appraiser's opinion on what they think somebody will pay. Market price is what a buyer actually pays for it. Market price, closed properties help determine the current market value. As market price goes up, value goes up. If market price goes down, then value is going to go down. Market price is the fact. The value is an educated guess, an educated opinion. Since nobody put your hand up when I asked if we were appraisers, I'm going to presume that none of us are. And because none of us are appraisers, brokers, we need to take that word value out of our vocabulary. Value is the word that the appraiser gets to use. Words matter, you guys, and we need to be very careful on how we respond to buyers and sellers. And what you and I say, we don't say value. We say probable sales price or probable lease price. Words matter. So at that listing appointment, when the seller's looking at you, they're going to ask you at some point, what's my home worth? What they're asking you for is value. Now, we don't need to go about correcting everybody, but we need to be careful what we say. The appraiser determines value. What I can offer you is probable sales price. When you and I report probable sales price, we're going to do it in a range. When the appraiser's given value, they get to use a specific number. Do not run around acting like an appraisal. Thank you. Acting like an appraiser. The appraiser gives a specific number. They get to say the word value, worth. You and I report in a range, and we're going to determine probable sales price. Or if you're going in the property management world, we're going to determine probable lease price, what we think the rental market is going for. So let's put our appraiser hat on, broker hat off, appraiser hat on, and let's talk about value and different things that impact value. What's the three most important things about real estate? Location, location, location. So true, so very, very true. And the location determines value. Some parts are more desirable than others. Some properties are on water. Some properties are on a golf course. Some properties are out in the middle of nowhere amongst, 5 acres of land, 20 acres of land, or whatever. Location matters, and it absolutely impacts value. Not just where it is, but what kind of growth is that area seeing? In North Carolina, we're seeing lots of growth. We're like one of the top 3 states to move into right now from other places in the country. But those other places in the country may not be seeing growth because all those people are moving to North Carolina. They may be seeing decline. They may be seeing dying cities, dying areas. So value can absolutely change based on where. The seller's time frame or their reason for selling. Some sellers, for all sellers, it comes down to time versus money. If you want a lot of money, I need more time. If you need to sell quickly, you may not get as much money. Helping the sellers identify their time frame, their agenda, the reason for their selling, how urgent their need is. If you have an area of decline, you probably have a bunch of people that have to sell fast because they got to go somewhere else for a job. So the seller's time frame, everybody's got to sell fast, for example. Improvements to the property. Capital improvements add value. Capital improvement is not painting a room or cleaning the carpet. Capital value is adding square footage. Did you build a room on the back of the house? Did you finish the unfinished basement? What improvements add value? Again, slapping a coat of paint on something doesn't affect value. It just affects how we see it. So capital improvements to the property. What's the condition of property? Now we're saying a clean home is perceived to have more value than one that's not. The fresh coat of paint can go in a long way because it shows a better condition. How does it look to us? The market. We've talked about the market. We've talked about being experts of the market. This is where we say stuff like we're in a seller's market or we're in a buyer's market. We don't sit around in real estate talking about supply and demand. We talk right now, I'm in a seller's market. Why do I say that? Because demand is high, supply is low. One day we'll switch gears into a buyer's market. I don't know when, but one day we'll be in a buyer's market again, which means demand is low, supply is high. And that's understanding the market, what type of market we are in, who's in the driver's seat right now will absolutely affect the value. And then the neighborhood back to the location. Does it have desirable amenities? We like the idea of having our work and our grocery store, our church, our schools. We like having all those amenities near-ish by for convenience. Is the neighborhood seeing growth? Is the neighborhood seeing decline? These are all things that the appraiser considers. So what we're saying is that while you and I are the experts of our market, so is the appraiser. The appraiser knows what's going on with the market, as that all affects value. Other things that affect value, economic forces. So as employment goes up, we can expect value to go up. You got a bunch of people moving in because they just opened an Amazon plant. So now we can expect employment to go up. We expect people need somewhere to live. So we can expect that to affect value. Wages go up, interest rates. That's where we're living right now. Fluctuations in interest rates. We wish they were, a lot of people wish they were a little lower. They are what they are. Higher the interest rate, the fewer buyers you have. The lower the interest rates, you're probably going to put more buyers into the market, into the shopping housing market. So again, being the expert of the market, knowing what's going on in the economy in that market. I remember several years ago, it's been a while now, if you're familiar with Carnersville, and I remember when Caterpillar announced that they were going to open a big plant in Kernersville. And I don't remember how many jobs they created. But what do y'all think happened to the value in that area once Caterpillar made their announcement? Yeah, values went up. There was a need, there was a demand. Flip that coin, around that time, maybe not exactly that time, but around that time, Dell in Kernersville announced that they were closing their doors. They were losing jobs, they were losing people. That affects value. Another thing that affects value is government control. What's going on with zoning? Are we preparing for a lot of changes? Have we not seen changes in a while because we don't have that growth, we don't have that need? Are there environmental concerns going on? You go down east, for example, you go down east and you're running into more so into like fracking, which could affect the values on the property, rent controls, taxes. People absolutely take taxes into consideration. Did y'all know Guilford County is known for high taxes? And there are people that will move to the other side of the line to get into Davidson or Davie County just so they don't, for example, have those taxes. Some areas are known just being higher tax. All that affects the value on the property. Other environmental things that influence value. What's our availability to natural resources? Think about our wetlands, for example. Is the soil, can it handle building? Can it handle growth? If you're on sand dunes, you don't have good soil. All in how stuff absorbs and how you can build and support. Is the area prone to flooding? Flood zones can absolutely impact what the property is worth. So the appraiser looks at a whole lot, not just a specific property. Again, they are the experts of their market. Another thing that can influence value are social trends. We see dynamics under the roof changing. You got adult children moving back home with mom and dad. Shoot, you got mom and dad moving in with adult children. We've had two transactions, well, actually, we've had 2 times this year where mom and dad and adult kids have each sold their home, and the 4 of them have gone in together and bought one. We've had that happen twice, 2 listings and 1 sale, just from those people. That's a social trend. The family dynamics under the roof are changing. You have family sizes tend to be getting smaller. When people have kids, when people get married, all that are social trends. And as we see those change in society, we're going to see that affecting the value. Tiny homes, that was that rush a couple years ago. We mentioned supply and demand. Again, I don't sit around talking about supply and demand with my broker buddies. But what we do talk about is a buyer's market and a seller's market. So without saying supply and demand, we're talking about the market. Knowing what kind of market we're in helps us determine listing price, rental rates, etc. Is it a hot market? Is it a buyer's market? Etc. So better understanding of where that word value comes from. Again, that's the appraiser's word, not ours. But a better understanding of where that word value comes from and all the things that the appraiser needs to take into consideration. So before the appraiser, when they kind of do their thing, they set their parameters. They say, this is the area or areas I'm willing to go. And when a need for an appraiser comes up, it beep, boop, boop, randomly generates the appraisers that have signed up for that area. So if the appraiser doesn't want to go out of the triad, for example, then they're only going to set their parameters for the area that they know, the market that they know. Questions so far? Well, the things appraisers take into consideration, there's something out there called the law of substitution. And what the law of substitution says that when consumers, whether you're out there buying a house or a pair of tennis shoes, we're all consumers. And when consumers are faced with almost two identical products, you have almost two identical homes or almost two identical pairs of tennis shoes. When the consumer, the law of substitution says when the consumer is faced with two almost identical products, we're naturally going to go towards the lesser of the two. If we don't see the value in paying $450 because they're almost identical, we tend to gravitate, we tend to focus more on the lesser of the two. And same thing, we've all bought tennis shoes and clothes and cars and everything else, and we tend to price shop, price compare a lot. And if we don't see differences, human nature says we're going to go for the less, the cheaper, if you will, of the two. The law of conformity says that value is met when it matches its surrounding areas, when it conforms to its surrounding. Now, I'm not saying properties that don't conform don't have value. What we're saying is we may have to find their value a different way. Have you guys ever been out, maybe a Sunday afternoon drive, and you're in a 2-lane road out in the middle of nowhere and you really have no idea where you are, but you trust your GPS? Windows are down, radio's up. It's a nice Sunday afternoon drive. And you're on this 2-lane country road and you pass brick ranch after brick ranch after brick ranch. And you round the corner and you look up and bam, there's this monstrosity sitting on top of the hill behind a gate. This thing doesn't conform. It doesn't match its surrounding. So the appraiser may need to take some extra steps. They may need to do some extra things to arrive at value because they can't use the surrounding area. They can't use those brick ranch as it doesn't fit. Some other appraiser words. Contribution. The appraiser looks at how the value contributes to the property. How do the improvements contribute to the property, to the value of the property? Not much makes me more nervous than when a homeowner starts rattling off all the features of their home and I hear a bunch of custom built and custom design. Because what it was custom built or custom designed for was probably them. That may not contribute to the value for the next owner. They may not see the value in that custom built, custom designed. I'm all about homeowners doing what you want to with your home while you own it. I'm all about it. But homeowners need to understand that your improvements may not contribute to the value when you turn around and sell it. Again, it may not be seen as value to the next buyer, to the next owner. Appraisers need to look at anticipation. What are the future expenditures going around? Are we going to build a belt loop around the city? Are we shutting down a plant? What are the things that may happen in the future? What are we anticipating? They built that belt loop around Winston. They've been talking about it for so many years. And all those people in Kernersville, all those people north Winston that are in the line of the belt loop have been anticipating that thing coming for a long time now. And the value of their property has been affected because of that anticipation. Question comes in, can I encourage a buyer to put an offer based on your personal appraisal? So what I'm not going to offer them my appraisal. What I'm going to offer them is my CMA, my comparative market analysis. And I'm going to tell them based on my research, this is what I think the home's going to sell for. But all I'm doing is offering my educated number. I'm not just blurting a number out. I'm providing them facts. I'm providing them numbers with my comparative market analysis. Remember, I'm a fact finder. I provide the information for them to make an informed decision. And when they look at me and say, what should I offer? What should I pay for this house? I'm going to respond with my market research, with my CMA, so they can come up to their opinion. The other thing appraisers take into consideration, go to the commercial world with me for a minute. And in the commercial world, they're going to consider competition. How do profits attract new competitors? What do we have in this commercial retail area that attracts consumers? My Winston-Salem people, or if you're not Winston-Salem, anywhere, you can find some kind of shopping center. Specifically, my Winston-Salem people, you're probably familiar with Thruway Shopping Center. There's a whole lot of fun things going on in Thruway, right? We can go to lunch at Moe's. We can go to a little kitchen gadget store. I think Rack Room Shoes is still there. Of course, you go to Dewey's when you go to Thruway. That's like a must, right? Thruway Shopping Center thrives on competition. If I go to Thruway for Moe's for lunch, Thruway wants me to stay and spend more money. It's the idea that Moe's got me there. And now that I'm there, what other competition do they have to keep me there? How else can I spend my money at Thruway Shopping Center? So we thrive on each other. Another thing the appraiser looks at, one of the more important things that we discuss, and something they look at every single time, something they consider every single time, is called something highest and best use. And highest and best use may or not be how the property is currently being used. What highest and best use says is that this use is going to produce the highest rate of return, the best results. The appraiser will always comment on what the highest and best use is. Now, whether or not that property is being used that way, does zoning allow it, covenants, etc., that's not what the appraiser is focusing on here. What they're saying is that if this were industrial and we were growing corn, I'm sorry, agricultural, and we were growing corn, its highest and best use would be farmland. Highest and best use can and does change based on the changing markets, the changing area. But there can only be one highest and best use per property. So if the property is not utilizing its highest and best use, it may not have maximum value. You're using this to grow corn. If it were retail, highest and best use, for example, it would make more. Questions on any of the appraiser's terms, words, I would just be, familiar. We don't need to go into a deep dive, but I'd be familiar with the terms, contribution, highest and best use, etc. Question or two. So put your appraiser hat down for a minute. And let's put our broker hat back on. So if we said the appraiser does the appraisal to determine value, what you and I do are CMAs and BPO to determine probable sales price or probable lease price. Words matter. I'm not joking when I say take that word value out of your vocabulary. Never look at a seller and say, I think your home is worth X amount. You just stepped out of your lane because you acted like an appraiser when you're not. Probable sales price. So today, CMAs and BPOs are pretty much used interchangeably. There was a difference once upon a time ago. Today, we refer to most everything as a CMA. But a real quick history lesson for us. Historically, the CMA was set aside for us when discussing probable sales price with sellers, probable sales price with buyers, or probable lease price with homeowners, investors, and tenants. So the CMA is part of our general brokerage duties. The CMA is part of just what we do when I'm trying to get this listing, when I'm trying to help this buyer, and if I'm a property manager. The BPO, once upon a time ago, was done for a fee. So you and I could perform a BPO for a fee, but we're never doing a BPO for our general brokerage duties, for just my job to help the seller determine their probable sales price. So the BPO was set aside for third parties that weren't interested in buying or selling the property. Examples. I used to work for a real estate firm that had a relocation company, and the relocation company was based out of Connecticut. And those people in Connecticut had no idea about the Winston market, what to expect, what's it looking like, is it a seller's market, buyer's market? Connecticut has no idea what's going on down here. So if they were about to work with a relocation client, one thing that they might do is request me to do a BPO. So they could pay me X amount to give my opinion, my probable sales price. This relocation company is not looking to sell the home. They're not looking to buy it. They're just trying to get an opinion. I'm a heck of a lot cheaper than an appraiser. So as long as they don't need that value, as long as they're okay with probable sales price, we could have done a BPO for a fee. Still are. We just tend to call them all CMAs now. Another good example of a BPO, this came up from a post-licensing student, and she was shadowing a broker. She was working with and shadowing a broker. And the broker she was working with got a call from a divorce attorney. And they were trying to settle the divorce decree. And so the property was involved. And to settle it, they had to have an estimate of value. So they called the broker to do a BPO, not to list it, not to sell it, but just for their opinion for that divorce decree. So historically, CMAs are what we do, just part of our job. General brokerage. BPOs were done for a fee, not general brokerage. Here's an important note. Soon to be provisional brokers. You guys. You cannot do a CMA or BPO for a fee. You can do a CMA or BPO, but you can't do it for a fee. Only full brokers can do CMAs, BPOs for a fee. Broker in charge, non-provisional. None of us, I don't care who you are, none of us can charge a fee for a CMA when it's just part of my job. Could you imagine a world where you're sitting in the listing appointment and the seller looks at you and says, what do you think my home is worth? And you respond, well, cash at me $200 and I'll tell you. That's not what we do. That's not what we do. When I'm sitting at that listing appointment and the seller says, what's my home worth? I'm responding with my CMA. That's my job, no fee. When the buyer says, this is the dream home, I want to write it up, how much should I offer? I'm going to do a CMA for the buyer to help them determine probable sales price. And I can't charge them a fee for general brokerage activities. So what we do, CMAs and BPOs, no fee for non-provisional brokers. And it's so important that you hear, we do not determine value. We do not say words like appraisal. What we say is we look at that seller in our listing appointment and we say, based off of my comparative market analysis, I think your probable sales price is, we're going to look at the tenant and say, based on my comparative market analysis, I think the probable lease price is. So here, see the differences. The appraiser does the appraisal. You and I do the CMA, BPO. Non-provisional brokers can never charge a fee. None of us can charge a fee when it's just part of my job. Questions? So I got one for you guys. Why don't y'all pull your chats up? And you can abbreviate. So let me ask you guys a question. Your opinion, appraisal or CMA? So what do you think is more accurate? Which one is more accurate, do you think? The appraisal or the CMA? Thank you guys for weighing in. So which one is more accurate? Yeah, it's going to be the appraisal because the appraiser is the one that's given a specific number. They're saying in all their education and all their experience and all their specific training just for this purpose. That's what they do for a living. What they do, they're going to be more precise. There's a lot more that goes into preparing an appraisal than there is going into a CMA that you and I prepare. Again, the appraiser gets to give a specific number to the penny in some cases. The broker, we're given a range. I'm reporting in a range. I'm avoiding those specific numbers. So yeah, I would definitely say the appraisal is more accurate, more precise, just the process itself. With that being said, you and I, it's important that we're properly preparing these CMAs, that we're properly preparing these for our sellers and our buyers, because as we've already learned, the lender's loan to value ratio is based off of the sales price or the appraisal, whichever one is less. So the closer my opinion to the probable sales price is, the closer to the appraisal it is, the less hiccups we're going to have in that transaction. Question, somebody comes in, the appraiser does offer an opinion, and you know what? So do I. We're all looking at different data, different research. So yes, it is one person's opinion. But if they're trained properly, they know what they're looking for. And we're going to get a little bit more into what they're looking for in this next section. So both of them, and that's a great point. Thank you. Both the appraisal and the CMA are just people's opinions. So when I'm doing a CMA, getting ready for a listing appointment, I need to make sure that I'm properly pulling my CMA. Because if I'm in a competitive listing appointment, I want to make sure that I am true reflection to the seller, even if it's not competitive, a true reflection to the seller about what I think I can sell their home for. As far as pulling CMAs, we do not do that in pre-licensing. That is a when you get licensed thing to look forward to. We do our CMAs through the multiple listing services. It's a nice little program, clickety click. You'll get training on CMAs when you get into your firm. I know a lot of MLSs offer CMA training, a couple times a year. Try at MLS, you probably get it 3-4 times a year. So you guys are not getting the how-to yet. Remember, my job is to get you your license. Once you get your license, you get out in the real world, then you learn how to be a broker. So know that you got much more of that coming. And again, the key word, to properly do a CMA. So we talked about those fees. Provisional brokers, you cannot charge a fee, a separate fee to do BPO or CMA. None of us can charge a fee when it's just part of my job. So helping the seller determine what we can list or sell and list their home for, two different things, probable sales price to start. And then from there, we can gauge what we think a good listing price is. A lot of that depends on what market we're in, seller's market, buyer's market, the condition of the property, how does it compare to others nearby, et cetera, et cetera. So none of us can charge a fee. It's part of my general brokerage duties. Provisional brokers cannot charge a fee to do a BPO. You can do a BPO, but you can't charge a fee. First few CMAs you do or BPOs you guys do, your BIC will be sitting there with you. Like I said, there's plenty of training. So just know you have that to look forward to. What questions do I have? So just for a moment, I'm skipping ahead. Where we're heading next week, we're gonna, or no, Thursday. Today's only Tuesday. So where we're heading next class, we're going to get into the appraiser's approaches to value. The appraiser can use one of 3 or 2 of 3 different approaches. So we're going to talk about the sales comparison approach. We're going to talk about the cost approach, and we're going to talk about the income approach and when the appraiser would use each approach. There's 2 very important things with this conversation. One, there's math. We're going to pick up the calculator for all 3 approaches to look at mathematically how the appraiser comes to that. And then the other important thing is which properties is the appraiser going to put the most weight on the approach. So Thursday, we're going to pick up here. We're going to talk about the appraiser's processes. On Thursday, we will finish, where are we? We will finish Unit 7, and then we will get into Unit 8. Unit 8, we're going to put our broker hat back on. We're going to put buyers and sellers under contract. We've created agency. We've got them a loan. We got them a probable sales price. Let's write up the offer, you guys. So we're going to put them under contract in Unit 8. Please look ahead. I got a question about the CMA and BPO. And again, they're pretty much used interchangeably. Historically, the difference is the CMA, it's the same thing. The CMA was done for my general brokerage. the BPO was done for a third party. So the divorce attorney, the relocation company is generally going to ask for a BPO. I'm saying the same thing. It's the same process. It's just in who's ordering it. So that's where we are. Thursday is, yeah, we're going to finish 7. We're going to get into 8. And then, of course, we'll talk about what next week is going to look like. Everybody listen to me real quick before we go. In about 9 minutes, you're going to get an email. And the email is going to include your midterm. If you don't get it, please reach out to me today. But I got it set up, loaded, ready to go, scheduled to go out at 2. The midterm is due by Monday. Please take time to do the midterm. Do not plan to do the midterm in class next Thursday. I would consider that a distraction, and I will get the report that tells me you took the midterm while we were in class. So I'm asking you not to plan on taking the midterm during that time. Fair enough? Make 2 hours for yourselves to prepare yourself for this end of class exam. If you have any questions about the midterm, please feel free to reach out to me or Lane. 8 minutes. So you guys have time. If you want to take it now, awesome. If you want to wait, just plan to do it before next Monday night. Fair enough? Questions? Y'all have a good afternoon. Have a good day tomorrow. We'll see you guys on Thursday.